place of these committee meetings was publicized by notifying the area news media, by updating OPPD website, by emailing such notice to each of the district directors on June 14, 2019. As we discussed at the April meeting, we're going to hold any closed sessions at the beginning of board committee meetings. On today's agenda, we have two items to discuss in closed session. Corporate officer performance reviews of Julie Comstock, Vice President of Customer Service, and Lisa Olson, Vice President of Public Affairs, which includes a discussion on compensation matters. And we're also going to discuss the Enterprise Risk Management Quarterly Update. Dr. Kavanaugh?
Time I move the board go to closed session at this time, 8:30 a.m. to discuss corporate officer performance reviews and compensation adjustments for Vice Presidents Julie Comstock and Lisa Olson, and the Enterprise Risk Management Quarterly Update. With respect to the corporate officer performance reviews and compensation adjustments, closed session is necessary to prevent needless injury. Clarifications of Ms. Comstock and Ms. Olson and neither has requested a public meeting. With respect to the quarterly Enterprise Risk Management Update, closed session is necessary because the discussion involves matters that are confidential, protected by the attorney-client privilege and attorney work product doctrine, and involve the discussion of security, intellectual property, and utility infrastructure.
Motion requires a second.
Second.
Bogner?
Yes.
Kavanaugh?
Yes.
Gay?
Yes.
McGuire?
Yes.
Omaha? Moody?
Yes.
Williams?
Yes.
Yoder?
Aye.
The motion to go into closed session is passed. This closed session will be limited to discussion regarding corporate officer performance reviews and compensation adjustments for Vice President Julie Comstock and Lisa Olson, and the Enterprise Risk Management Quarterly Update. No votes or action will be taken. Thank you. Okay, do we have a motion to go out of, to reconvene open session? Okay. May we have a vote?
Okay, Bogner?
Yes.
Kavanaugh?
Yes.
Gay?
Yes.
McGuire?
Yes.
Mulhoff?
Yes.
Moody?
Yep.
Williams?
Yes.
Yoder?
Yes.
The motion to come out of closed session at 10:12 a.m. is carried. This closed session was limited to discussion regarding corporate officer performance reviews and compensation adjustments for Vice Presidents Julie Comstock and Lisa Olson, and Enterprise Risk Management Quarterly Updates. No votes or other board actions were taken during this time at the closed session. Okay, so we may open the session. Thank you.
Yeah.
I'm gonna run it.
Let's do it.
Okay. I'll take notes for you.
Which review
Earlier before the closed session, I made an announcement regarding the public notice of this meeting. Today, we're going to hear the following committee reports of Finance, Systems Management and Oversight, Governance, and Public Information. Tim Burke will now give the safety briefing.
Yep. Welcome. You're on the 9th floor on the west side of Energy Plaza. Most of you have heard this. We have a couple folks that haven't heard this safety briefing before. But in the event that we need to leave this room in case of a fire, we would take the steps, not the elevator. We'd take the steps all the way down to the main level, exit out on the 17th Street side of the building. In the event of a tornado or severe weather, we would actually move to the call center area, which is a secured area for tornadic or severe weather. If you use the steps, please make sure you use your 3-point touch, one hand on the railing, 2 feet on the ground. The fire extinguisher is right behind me in the event there's a fire here. The AED and the first aid kit are to the right of the elevators. And is anybody here certified in the use of an AED or in CPR? If you could raise your hand, so there's quite a few people. Those of you that aren't, I would ask you to go back to the OPPD wire story and listen to Kevin McCormick and his wife talk about the value of understanding CPR and the use of an AED. I think it's incredibly important to understand that, and it's a great example of the value of that. If anybody has a medical condition, we would ask you to write it down or tell your neighbor. And would anyone be willing to call 911? Kevin will call 911. Thank you, Kevin. I appreciate that. Any questions to the safety briefing? That concludes the safety briefing. Thank you.
Thank you very much. Next, we'll have the finance report. Mr. Gay.
Thanks, Rick and McGuire. We've got a busy morning on this. We had a pre-committee meeting, a telephone conference call to discuss a few things. We're going to have 3 things on here. We'll do the May financial reports. There's an opportunity, authorization to increase commercial paper program, which Javier will report on. And then also we're going to go over, and it looks like have a presentation on the rates monitoring report for your approval. That will take a good amount of time as well. So I will turn it over to Javier. And Javier, you want to start us out, May financials?
Certainly. Good morning, everyone. The May financial report is out. I'll just summarize these as that it was a more normal May than last year. Last year we experienced the warmest or one of the warmest Mays on record. This year temperatures were somewhat similar to what we had expected and budgeted for. Therefore, retail revenues for May were almost on budget. $73.2 million, which is $1.7 million over budget. Pretty steady there. Off-system sale revenues for May were $12.3 million, which is $2.6 million over budget. We did generate power and we did sell it on the market, and we generated a little bit more than what we had expected on the budget. However, I'm going to skip to a couple of bullet points down on the fuel and purchase power, which for May we had $30.6 million of fuel and purchase power expense, which is $6.8 million over budget. So this month, as opposed to the previous months, our fuel and purchase power expenses were over budget by more than the off-system sales revenue were over budget. A number of reasons on that. We had 2 units that were out on planned outages. That, coupled with market prices, created this discrepancy over budget. All in all, it's not something that concerns me that much. We're going into the heavy warm season now, June, July, August, September. We are fortunate that we have all of our units up and running, and that should help with the budget piece.
If you look at the year-to-date, it's consistently different from the budgeted amount for both of those categories.
Correct.
Is that just kind of an anomaly for this year, or do we see that as a structural change of some sort?
Great question. What I tell my team is it really doesn't matter how off, or I should say, it doesn't matter as much how off we are from the budget as long as those 2 lines track each other, right? If prices go up and they go up when we're buying power and when we're selling power, And as long as that delta is maintained from a budgetary perspective, it really doesn't affect us that much. It is when those two lines diverge significantly. And we had something like this happen back in 2017 when we had a tornado come through the region and tore down a big portion of our transmission system, where the divergence in prices between the south and the north part of our region created that discrepancy where we were buying power at significantly higher prices than we were selling power in the south. Those types of events are events that concern us, and we are actually looking into that as part of an enterprise risk management. We'll hear about this later on SD15, the ERM monitoring report. We're looking at this particular risk as one that we may want to elevate on what is the risk of when there's a discrepancy between off-system revenues and purchase power that could create an issue with the budget. But for today, year to date, we really haven't seen that happen. Knock on wood. We're tracking relatively close to budget.
Thank you.
And if you remember, in 2017, we did some interesting risk mitigation strategies to defer some of that significant changes, right? So we were able to reduce some of the risk around that.
Another thing that I would like to just remind the board, and this is part of what the board approves at the end of every year before the start of the new year, is also the fuel and power purchase adjustment. There's an automatic clause that if we see significant deviations or significant market shifts, we have an automatic clause in our rates that would allow us to adjust our rates going upward or downward if market prices go that way. But that's certainly something that we're looking at right now, and we will continue to keep the board updated as the year goes by. I would want to wait until the hot season goes by, and then we'll see how we do at the end of the summer. Other income for May was $11.7 million, which is $5.2 million over budget. And you may ask why. The answer is exactly the same as I've been giving in the past few months, which is interest rates continue to decline. And this is just a mark-to-market effect. It's a non-cash effect where we are holding securities today. We have a buy and hold strategy, but we're holding securities today that we purchased when interest rates were relatively higher than interest rates that prevailing interest rates. So when you mark to market those securities, they're worth a lot more money compared to if you were to repurchase those securities today. That is the majority of the explanation for the $5.2 million over budget on the other income side. If you remember last year, the explanation was exactly the other way around. As interest rates rise, we had losses on a mark-to-market basis. This time around, it's the other way around. Operating and maintenance expenses, excluding fuel and purchase power, were $32.1 million for May, which is $600,000 under budget. Again, the teams are executing incredibly well, and this is part of, again, a shout out to our financial business partners, all of my colleagues with senior management. We are really living through a very disciplined budget process, and we're executing all of the work that we had implemented through the Custom Process Improvement Initiative. We are making it happen with
Is that a time
O&M.
factor because of the flood or because of rain?
No. We will have issues with the flood and the rain on capital projects, but from an O&M perspective, we're really not seeing that
Okay.
big of a change. Other expenses for May were $32.5 million, again, $200,000 under budget. Same explanation. We're managing those budgets really well. All in all, this brings us to a net income for May of $2.1 million, which is $3.5 million over budget. We had planned to have negative net income in May. Our net income in May is positive. I want to repeat the caveat that part of that positive has to do with the mark-to-market of our securities. So it's not necessarily a cash element, but it's certainly something that we welcome as we have securities that are valued more today than if we were to purchase them in the more open market. Year-to-date net income is a loss of $2.5 million, and we're still ahead $1.7 million over what we budgeted for the year. So we're in a good position as we start the warm months financially. We weathered a severe flooding event in March and April. We have completed the outages of our 2 large generation units, and things are looking okay for now, and we'll continue to report back after the end of the summer. I'll continue to report back every month, but probably at the end of the summer I'll have something more consistent, more relevant. Capital expenditures for May were $19 million, which is $7.5 million under budget. We are still dealing with quite a bit of the aftermath of the flooding event, and the ground is saturated, and we're trying to get as much work done, but we're still having some pockets of our territory where it's been hard to get and complete capital projects. Year-to-date capital expenditures, we are at $69.6 million, which is $27 million under budget. So this is a focus of mine and a focus of senior management as we continue to look at our capital portfolio to make sure that we execute on it and that we deliver the projects that we set out.
Obviously, it's significantly, under budget. Shouldn't our cash balance reflect that in a positive way?
Yes. Part of it is that, and we have our unrestricted cash balance at the end of May was $365 million, which is $3.3 million under budget. On the cash piece, so your point is absolutely correct. On the budget piece, we have been assuming certain cash balances from previous years. So when I'm doing the comparison to budget, unfortunately, I'm also picking up what we had planned in 2018 and 2018 into 2019 for cash balances. We also had a big cash disbursement made in April for our pilot program. That was part of the budget, but it also helped reduce our cash balances. I'm going to touch on our cash balances on the next topic in a little bit more detail. But cash-wise, we're doing okay. Capital expenditures, again, this is a focus of mine. We have a lot of work to do. We have a lot of really good projects to complete. We want to make sure that we're giving the teams as much resources as they need to complete them on time and safely. And with that, I conclude my report for the May financial report.
Any questions, additional? All right, let's roll right into the next topic. This is an opportunity, probably. So.
The next one is it's a great opportunity, and I'm always excited when I talk about these type of opportunities. In front of you, you will see the draft resolution that will be presented for the board's consideration on Thursday to approve and increase to the commercial paper program that we have today. A little bit of background on these. We have currently a commercial paper program, and we've had it for a number of years, where about 8% of our total debt portfolio, 8% of that is commercial paper. Commercial paper being notes, debt instruments that we issue to investors, and those mature no more than 270 days ahead of the issuance date. They are considered short-term. They're not variable rate in the pure sense of variable rate, because once the rate is set, it's set until the maturity, but they mature so shortly that we consider them as variable rate. That rate is reset every time the commercial paper matures and you sell another portion of the commercial paper. We've been very effectively managing the commercial paper program. What this has allowed us to is to reduce the interest expense that we pay, because we're issuing debt in the short end of the curve. Investors demand a lower interest rate for such a short paper. We have an opportunity to increase the amount of our commercial paper program. This is something that I've been working with our team. I have John Thurber, our Director of Treasury and Financial Operations, and John Petrulis in the back, our Manager of Debt and Investment Management. We've been looking at an opportunity. We hold today between our revenue fund, our construction fund, and other liquidity that we have in the district, about $540 million of cash that we have invested for the district. That cash earns variable interest rate as well, right? We invest that cash in short-term securities, and as interest rates go up or go down, the interest we earn on that cash goes up or goes down. Under an asset liability matching concept, there is an opportunity for us to match or closer match our debt profile to the amount of cash we have in the district, right? There's an opportunity for us to increase the commercial paper program from $150 million to $250 million. That's a proposal that you will see on Thursday that I'm talking about here today. What this would do is it would allow us to refinance long-term fixed debt we have today in our books and reissue that under the commercial paper program at significantly lower interest rates. The catch is now you'll have a lot more variable rate than you had before. Our portfolio would go from 8% of variable rate to somewhere around 15% of variable rate. The risk is if you have the more variable rate you have on your portfolio, the more exposed you are to interest rate increases. And this is something that caught a lot of municipalities, a lot of corporations on a bad place in 2008. Holding a lot of variable rate on their portfolios, interest rates go through the roof, and all of a sudden you owe a lot of interest expense. Certainly that's something that could potentially happen to us. The reason I'm presenting this to you is because we have an asset liability matching principle where we have enough cash on the asset side of our books that is also earning variable interest rates. In the event interest rates increase, both our debt expense, our interest expense on the short-term debt would go up at the same time as our interest earnings would go up, providing a natural hedge both for increasing or decreasing interest rate environments. Today, I believe that we have an opportunity that we're missing on by not having an increased commercial paper program, given the amount of cash and liquidity that we're holding on the district. We could refinance the debt that I mentioned earlier, refinance it with long-term fixed rates. The savings wouldn't be as high, and we wouldn't be taking advantage of this program. So the proposal here is to increase the commercial paper program from $150 million to $250 million. One last thing I'm going to mention is, as we're looking at doing these, I tasked my team to figure out governing metrics that will tell us when or if we should change that strategy. If interest rates all of a sudden start going in a different direction, or we didn't plan certain financial conditions, we have the ability to take some of that commercial paper program, the commercial paper, and reissue it as long-term fixed debt. So it's not an irrevocable move. We can always move back from commercial paper back to long-term fixed rate. One of the most important metrics, if not the most important metric that the team, along with Barclays, who is our financial advisor, they ran a ton of models, and the conclusion was we are going to manage this program with one very specific metric, which says our interest earnings on our cash balances on a projected basis have to be at least 1.5 times the projected interest expense on our commercial paper. So we will have always that extra cushion of 0.5 times of interest earnings compared to interest expense. They've stress test our models, assuming really high interest rate environments, really low interest rate environments, and in every single one of those environments, OPPD ended up spending less interest expense compared to the interest earnings we're holding, as long as this metric of 1.5 times was maintained.
Maybe I'm on left field if I am, tell me. Is it fair to say that by basically refinancing from the longer term set interest rates to a shorter term, lesser rate, I guess, if you will, are we banking on a reduction in interest rates short term?
That's a good question.
Is that part of the incentive?
No. I do have views. I do have my views of where I think interest rates are going to go, and there's a higher likelihood that interest rates may go down later on this year, but that is not the reason why we're doing these.
Okay.
In fact, it should be agnostic to where interest rates are going. Right? This is not OPPD taking an opportunity on the market today. It's us taking an opportunity on the cash balances we have today, where regardless of whether interest rates go up or down, these would still hold. And I think that's part of the fiscally disciplined approach that I've asked the team to do. We're not speculating on the market. These would work either way. But great question.
So you mentioned that's not the purpose of why we're doing this. The purpose is increase the commercial paper. What is the purpose to the operations of the district, aside from the debt ratios? I mean, does this allow us more capital to complete projects?
The purpose of this is to achieve debt service savings. Today, we have long-term debt with fixed rates that are significantly higher than what we could refinance them at under the commercial paper program. In fact, we're estimating that by increasing the commercial paper program from $150 million to $250 million and essentially refinancing $100 million of that debt would generate savings to the tune of $30 million per annum. No, not per annum. $30 million total. About $1 million, a little bit over $1 million per year to our operation. So that's the bottom line for doing this.
So it's a financial tool only, and will have financial impacts, but it won't necessarily translate into any different operational project completion schedule or flexibility. And
it does, and I think this talks to the fact that we're fiduciary. We have a fiduciary responsibility to our ratepayers in trying to shrink the cost of overall OPPD, and this is basically doing that.
Great, thank you.
Yep.
Javier, can you talk about how you're going to monitor this program internally? I know with John, or you got a whole team. Can you talk about how you watch this? Because it is short-term
Right.
rates.
This is something that I'm working with John and his team on monitoring these at least on a monthly basis for the beginning of the program. At some point, I'm estimating that by the end of this year, once we have this program up and running, we may revisit these every 2 months or every 3 months on how are we doing with interest rates. But it's something that we will continue to monitor periodically, where what's going on with interest rates, both on the investment side and on the borrowing side, and making sure that we are always covering on a prospective basis with a 1.5 times coverage. We have in our treasury and operations team, we have weekly meetings on the teams meet every week on discussing and debating interest rate strategies for some of our investments. So this is something that the teams are monitoring all the time. From my perspective, I would monitor this at least on a monthly basis, and then we'll report to the board if there was anything relevant to report.
And you've already identified the $100 million out of the 2014 series bonds.
Correct.
Have we already given you that okay to go ahead and to do those bonds, or what is that protocol as far as time frame for that?
So there is no approval needed for us to defease, to pay off bonds. Really, the approval that we'll be looking at here will be to increase the amount of commercial debt, commercial paper program, which is the vehicle that we're going to use to refinance the bonds. Okay. So that's the one that we're going to be looking at on Thursday. The approval is for the commercial paper program.
And as soon as you do that, then you can go ahead and start the defeasement of those 2014 bonds.
Correct.
Okay.
Now, very likely in the next month or two, I may come back to the board and with different opportunities. Something similar to what we had last year, which would be more of a traditional refinancing. So I just want to make the distinction that this is not similar to the refinancing we did last year. We may have an opportunity to even further refinance our debt later this year under a more traditional or something similar that we did last year. That one would require the board's authorization to issue new refunding bonds. Or new debt. In this case, it wouldn't be refunding bonds, but it would be a slightly different process than this one.
Right.
But we do every year give you authorization to, if he needs to make a quick decision and get a better rate and all that on those bonds. You have that, right?
Correct, and
Give it-
I just want to make it clear that this is separate. We may have an opportunity to seek an additional authorization later this year for additional refinancings, and those would be two separate authorizations.
Yeah. So, well, that's good. That's good news, I think. But basically, between now and Thursday, this fairly speedy thing. If you got questions, feel free to talk to him so you completely understand what we're doing. But really, it's short-term cash management opportunities. I appreciate you and your team coming up with this. It's kind of in its
a great
wheelhouse
idea.
of what you did earlier. You have experience doing these things, so I feel fairly comfortable with that.
Yeah.
And I do like that you have got, you know, a protocol as far as looking at this, you know, and if you have to change back to, you know, long-term bonds. I appreciate that.
I just have one question. This doesn't increase or decrease our overall debt,
Excellent question. No.
but it does it allow us to, in the future, decrease our total debt or facilitate payment of that debt in an accelerated manner, or is that even a long-term goal, is to decrease the amount of debt that we have?
This is a
as an
great
organization?
question. So these does not increase the overall size of our debt portfolio. It merely refinances,
Right.
changes it from long-term fixed to short-term commercial paper. It provides interest expense savings, so we would realize those as soon as this calendar year and for the years to come. It does provide us with an additional option to pay off some of this debt. And by that I mean, typically when you have long-term debt issued to maturity, let's say that maturity is 30 years out, you only have certain opportunities to call that or pay off that debt without paying any penalties. By issuing this shorter-term commercial paper program, we would have more of those opportunities. If we have an opportunity to pay off debt, it allows us to pay off debt on a shorter-term basis without having to wait until the call date for it. So it does provide us that option. I am not expecting that to happen anytime soon, but certainly it's an arrow in our quiver that we could execute and pay off our debt without penalties.
But it might help us to maintain that debt to operations ratio that we have set as a metric.
Correct. It gives us
Could.
benefits. It gives us a lot more benefits and it doesn't give us any other downside other than the exposure to variable rate risk, which is covered through the asset liability matching.
So are we getting this opportunity because of our credit rating, or because we manage money well, or why did we not do this earlier?
I'll give you the short answer. I'm happy to get into this, but one is our financial health. Our financial health. We've been building our financial health for a number of years. We went through times a few years ago when we had to use our cash reserves to pay for infrastructure investment. We had the 2011 flood. We had contracts with fuel. We had a lot of reasons why we would use our cash to try to mitigate rate increases for ratepayers. We are in a position where we are now in year 3 out of 5 years of our no general rate increase. We have been building and continue to build our financial health. That is certainly putting us in a position where we have been able to bring our cash balances back to where we need them to be. $540 million sounds like a lot of money, and it is, but it is certainly one element that our rating agencies look at for financial health. And so having those cash balances, that strong liquidity, that strong financial health is allowing us now to put those assets to use and do these. Our ratings are certainly part of it. We were recently affirmed by both Standard & Poor's and Moody's with our current ratings, and we do not expect these to change. In fact, it would just probably be an affirmation of our short-term ratings. So that's a short version. The short answer to your question, it's our financial health, and we've been working really hard to get us to this point, and this is one of the benefits where our customer owners are benefiting from.
Well, your quick clarification of question. I think I heard you say roughly $1 million a year is the savings that we're expecting. Any sense for the likelihood that you see some variability on that? It's going to go significantly higher or lower. Are you pretty comfortable with that as a figure?
That one is an estimate.
Yeah.
What I can tell you today is I know what interest rate we're paying on the debt we're going to pay off. and I have an idea of what interest rate we're going to replace it with, at least in the short term. That is what gives me that estimate of about $1 million every year. Those interest rates could go up, could go down, so the $1 million could be more than $1 million savings, or it could be less than $1 million savings. But in no event, at least through the stress testing we did, in no event would we ever be upside down and paying more on interest rates, on interest expense. At least not on everything we tested, which we believe is pretty reasonable.
And then you'd mentioned, I didn't know, so you just mentioned other opportunities that come. I guess in the future, if you have other opportunities that come, for me, this is just me personally, I want to know who's back and what our checks and balances are, because there's no perfect financial way, as we've seen in the past. But kind of what are we doing internally is important to me. I assume, Tim, you follow these things all the time.
Absolutely.
And as a board, we need to follow these, but any other things you've got, that's kind of important to me, and I assume probably to others, is like, what are we doing to monitor these short-term movements, so. Anyway.
Well, I think that's why in the conversation with the senior team, they're putting together these governance standards about how they're going to review and evaluate and make sure that there's that delta difference, to make sure there's enough coverage and spread, so to speak, to create that ongoing value.
Yeah.
And so we felt pretty good. It's similar to some of the other kind of measurements we do internally anyway. So we'll continue to do that.
Yeah, and I don't know, if I don't want to create a bunch more work for you, don't get me wrong, but at some point, whether that's quarterly reviewed to the board too.
Sure.
Because, I mean,
certainly we can give updates to the board in a number of ways.
I think you and I have had a
we talked
conversation
about those quarterly reports.
Quarterly
This would be
reports
a
to the
good
finance
thing
committee, and that might be a good avenue for us to provide that information, that feedback.
Yeah.
Would
which we
somebody
can
be
do.
part of the risk management also to look at that, or not? Question.
It doesn't rise to that level. Again,
Okay.
if we were entering
That's my
into
question.
variable rate debt without the hedge, the natural hedge of our assets, I would absolutely, that would be
Then it
something
would
that's
be.
square into risk management. It's certainly something that risk has to look into it, but it's at a very different level because of the asset liability principle.
Okay.
My next question is for the board, whether or not you want this on the consent agenda or.
It's on the action item agenda.
I think it's on an action item, and I sort of feel it should be on the action item.
Yeah.
So,
That's fine.
Just
I
a
think
quick.
it's good to
sure.
discuss this
This is
at the board meeting.
yeah.
That's important, yeah.
Okay, and anything else on that? And we'll move on to, we have a rates monitoring report. Assume there's a presentation with this. Yep.
Thank you. Okay. It is my pleasure to present the Strategic Directive 2 on rates, the monitoring report. This was a collaboration between a lot of parts of the organization, especially in my business unit. A big shout out to our financial planning and analysis team, as well as our treasurer and financial operations team, who did a lot of work on getting this information put together. I'm clicking here. I need to click on here. Just a reminder, the board of directors revised the Strategic Directive 2 a little bit over a year and a half ago. This is the second year where we're presenting a monitoring report on the directive as it is written today. I'm going to go on each one of these elements in more detail in just a second. The first thing we were charged with is the board of directors shall establish a rate target of no general rate increases for a 5-year period starting January 1, 2017 and ending December 31, 2021. I want to pause there. This is, in my opinion, the most important, the hardest thing that we have been successfully achieving for the past 3 years. And it is not something that happens by accident. It's not something where we just do it. It requires a lot of disciplined approach to budgeting and managing our financial operations. It has been a collaborative effort with our custom process improvement initiative, our financial sustainability initiative, and we continue to make these a reality. I want to make sure that this is not lost, that it is incredibly hard to do this while maintaining our financial health, and we are doing it 3 years in a row, and we're very, very well positioned to complete these next 2 years. We also have a directional target. This is not new. The target is for 20% below the West North Central regional average published rates on a system average basis. We want to be lower, not only lower than the country, but we want to be lower than the region, the West North Central region. So how are we doing on that? Well, we haven't had a general rate increase for 3 years. We're in the third out of 5 years, and we believe that we're in a really good position to accomplish these in 2020 and 2021, successfully finishing the 5-year commitment to our ratepayers.
I'm sorry. Can I ask for a point of clarification? Can you highlight what specifically you mean by no general rate increase? I've had this discussion with some others recently, but what does that
revenue
term
requirement?
mean?
Our revenue requirement it's virtually the same today as we had it in 2016. The amount of dollars that the organization needs to operate hasn't significantly increased from 2016 through today. So that is 2017, 2018, and 2019. Those are the 3 years. That's what I mean by a no general rate increase. Rate design, energy consumption, changes in houses, in square footage, all of those things will have an effect on our customers, our customer owners. They may experience, and they have experienced changes in their bills. We have continued to implement the rates, the demand charge and the rate structure change at the same time as we're lowering the volumetric charge for our customers. All of that is done without us modifying the the amount of dollars that we need to operate the district. That's the no general rate increase. We're not increasing the pie. The pie has stayed the same. Who pays for it? How it's paid for? That's part of rate making, and that's part of consumption and customer preferences. But we have not had to increase the size of the pie. That's big, because we have experienced inflation on the goods and services that we provide, that we procure. We have also experienced inflation in terms of salary increases, and all of those things have happened internally with the district, and we have found savings to offset those increases. So that's the size of the pie hasn't changed, and that's what, in a very simplistic way, that's what we mean by no general rate increase.
The revenue requirements, right?
The revenue requirements.
And that's across all residential, commercial, industrial classes combined, or is that independent to each of the classes?
That is as a whole, district as a whole. And there are changes within different customer classes, and residential and commercial and industrial. We have to pass on the costs to specific customers who cause that cost. But overall, the revenue requirement really hasn't changed. We're still using the same revenue requirement and cost of service that we froze back in 2016.
Right.
Every year we check against it to make sure that we're matching with it, but we're living with the same dollars that we had back in 2016.
But the change within any of the rate classes does not constitute a general rate increase, is what's
not in this sense, no. So we have not asked the board to increase rates since 2016. There have been adjustments, minor adjustments to the fuel and power purchase adjustment clause, but we haven't had to come to the board and ask for a higher revenue requirement that would necessitate a rate increase.
Great, thank you
That's a
very
big
much.
deal, yeah. Thank you for the clarification. Then how are we doing with a regional comparison? We set a directional target to be 20% below the West North Central region average published rates. By the way, that region includes North Dakota, South Dakota, Minnesota, Iowa, Missouri, Kansas, and Nebraska. Big portion of our territory, of the Midwest. This graph shows where we've been and where we believe we will be when we compare our overall rates. And when I say overall rates, I want to pause here. We don't have an overall rate, but what we're comparing is the dollars that we recover from customer owners compared to the megawatts that we provide. That gives you a quasi rate. That's the one that we use to compare all utilities. We compare each other in the same way. We are at 8.6% below the regional average. This is an improvement from last year. Last year we were about a little bit over 7% below. This year is 8.6% below. And this is a direct result of the no general rate increase construct that we're living in. Unfortunately, as you can see here, actually what the number that you have here in 8.6 is as of 2017. Given the nature of the data accumulation and the analysis, we don't have yet official information for 2018. We have preliminary information, but we try to wait until we have the official information for 2018. That should be available sometime in October, and that should confirm to us whether or not this trajectory that we have here on the dotted line, on the dashed line, is true. So as of 2017, from 2016 to 2017, we had an improvement. Our rates were 8.6% below the regional average. We didn't have a general rate increase in 2018. We believe that most utilities in the region had inflationary pressures. So that alone should put us in a good place to continue this trajectory down towards 17% below by the end of a 5-year rate freeze period. Doesn't mean we're going to stop there. We can do more things after that, but I'm looking at the 5-year period and really that trajectory going down significantly. I'm going to touch on a few other things in the next few slides, if you allow me. Mike.
Is it fair to say we should possibly change the likelihood of the 20% below the regional average, 17?
That's a great question.
Pretty darn impressive still, don't get me wrong.
Great question. If you allow me, let me just go in here. I think a picture is worth more than 1,000 words here. Really interesting. This looks at that general rate concept that I'm talking about. It's not residential, commercial, industrial. There are graphs on those later. This is overall OPPD. We were 8.7% below the regional average by 2017. To your point, Director Kavanaugh, there isn't a lot of room down here for us to be 20% below. So the distribution of all other utilities, it's pretty tight, right? We want to aim to be 20% below the others. We can do two things: keep or reduce our costs, but also wait for these other utilities to increase their costs, right? And that's what we're projecting that may happen in the next 4 years, is that these other colored lines, these other states, will continue to face inflationary pressures. Those costs may go up, while ours will remain constant, therefore giving us the ability to be about 17% below based on the previous graph. What I want to point out is that there aren't that many utilities or that many other states that are significantly below today, right? And so to your point, is 20% an achievable goal today? I would say, well, based on this graph, not very achievable. There aren't many, if any, that are at 20% below, but I believe that the directional target is still valid, and I very much welcome the challenge the board has given us to try to achieve that. But I think it's important for us to know that we're already towards the bottom of the pack on the regional comparison.
One of the things that they told us in the workshop that I attended at the APA workshop was that sometimes it's not all that valuable to compare ourselves to other utilities. And is that really a metric that's valuable to us? Because we aren't like other utilities. We may not be like any other utility in that north central. And so maybe that would be something we would want as a board to look at down the road. Is this really achievable, and is this really a goal that we want to strive for? Because we really are a unique utility in that sense. I mean, even in Nebraska, we're unique. So maybe that's...
Well, I think
first of all, it's not achievable.
Sure.
And second, is that really a metric that we want to...
Yeah, I think that's a good point. The original kind of concept here is that you have most of these states are within the same RTO. So you're in the same SPP. I'm not comparing utilities in New York or utilities in California. So one is they're within kind of the Midwest. They're certainly within that market. Most of the utilities within this state are vertically integrated. So they're vertically integrated from a generation, transmission, distribution. Now certainly they're in each one of these have rural electric cooperatives, they have public power entities, they have investor-owned utilities in the same way. And so from our perspective, we thought it was a reasonable comparison for how we want to think about rates and what that looks like. But there are certainly other ways to think about what that comparison looks like.
It's an interesting question, though. I'm trying to think about what our ratepayers would want, right?
Yeah, and
How
maybe
they
there's
would
another
compare us.
metric that we could.
Yeah, I don't know. Where did the 20% come from?
That came, I'll answer it. Let me think where I think it came from.
Sure.
I mean, different boards, different worlds, whatever.
different
So we're getting beat up on why have public power? Your rates are no better than anyone else in the legislature, on and on. We were hearing a lot of that situation. It came up as a public utility. We don't pay shareholders and other things. When Edward Easterland was here, it's like, well, we come with a number. How did we get, like the Huskers, let's be number 7 in the country. I mean, we want to be number 1. We picked an arbitrary number, quite honestly, and started going for that because 10% would have been what you're paying your shareholders. And I think maybe he came up with the stockholder
Taxes.
Didn't it also have
ratio.
to do with the closure of Fort Calhoun? As far as
No, I don't remember that.
No, we were not
No.
talking about that at that time.
But I think, this is my memory, but correct me if I'm wrong. So then we came up with that as, well, let's pick a pretty aggressive number. And then you've been doing a lot of things with your, your challenges and what you're doing internally to control costs. So that's how it kind of came up. Back to that other slide showing it going like this, if that's not doable, you're going to know in October. It seems like we've come this far, and if we can get that, that's great. It was making an assumption that if we hold our line, others are going to keep increasing, but things change over those years.
Yeah.
So you got to remonitor this as you go and see. So I think it's up to each board to decide, but that's how I think we came up with that, Javier. Anybody correct me if
I would say the only piece I would say is that there is some value in, now that value has shrunken in being a tax exempt bonding that we
Yeah,
have.
that was
That's the
So
big
there's some,
difference.
but there's, that has narrowed based on where interest rates have gone. But the other piece was, if we kind of take a look at, if we were in the best kind of cost picture of operations, that we would be 20% below the regional average. And so you're right, we did make some estimates based on, if you take the best cost utilities in this region and compare the value or the benefit of tax exemption from bonds, that we could be 20% below. So that was the rationale at the time.
Yep.
I will tell you, we didn't, so there's been some changes. We used to have it as a date. We kind of pushed it back and said directionally we wanted 20%, because I think there was a concern on the board. You didn't want to force us to make decisions that would create other risks for the organization just by getting to that timeline. And so I would say from our perspective, this is one of those, as Kevin put it on safety, and as we talked about in other kinds of things in the previous session, it keeps our kind of feet on the fire from a continuous process improvement perspective. And it gives some visibility about how we're comparing with others in a similar region of utilities. So
I hadn't been back to the bond rating agencies since we've come up with this goal. Has that been an issue at all with the bond companies?
Great question.
I mean,
So,
are they concerned about that? Or?
so let me talk about the other side of the coin. Rating agencies are very focused on credit worthiness for investors, and they value the board's willingness to increase rates when needed. They want to see a utility board that is willing to raise rates and raise revenues when it's necessary, so that we can then pay investors back, right? So rating agencies also look at the customer owners and say, hey, we also want to make sure that you guys are not charging too much to your customer owners and you're affecting the economy and their ability to pay the bills. So it's a balancing act. We have been able to demonstrate to rating agencies that our rates are lower than the regional average, that our customers are benefiting from that, but also we've had to do a little bit more explanation on our no general rate increase period, our 5-year period. They've asked us, hey, how are you making that without breaking the bank? And this is where we spend a lot of time with them, explaining to them and showing how we are increasing our financial metrics, we're improving our financial metrics, and our cost and process improvement initiative and all the savings that we are achieving in the district is what's allowing us to proceed with an original rate increase. But to your point, if we didn't have these explanation, rating agencies would look at us not in a good view, but they would say, hey, shouldn't you guys be raising rates faster? Right? And we've been successful at demonstrating to them that we're doing this prudently. And the board will raise rates when need to, but not now.
Yes, I just want to make one more point about, so there are some SDs that we want to have a win and hit it, and then there are other SDs that we want aspirational goals, and I think that this is one of those aspirational goal SDs.
That's all it is. One thing, and I mean, we can continue to talk about well, it sounds like we're wrapping it up on this anyway, but this is something we obviously could talk about at the retreat or when we set rates. So a good discussion to have. And like I say, it'd be nice. You think in October you're going to have a more update to see if that's kind of
September, October, that's the time.
so that'd be a good time to, or earlier, to talk about this. But that's kind of how we got there. I mean, whether it's a doable thing or not, I don't know.
I appreciate the explanation. That's all.
Yeah.
Well, and the other thing, as far as rating agencies, we also have an automatic rate adjustment clause, you had said earlier, and that provides them with
They
the,
love that.
with, yeah, they,
It
rating
is a
agencies
positive in
should
their
really
view.
like
That's it.
that
Correct.
Stability,
Well, we also have the rate stabilization.
ability for you
the
to,
FFP.
That is
to
very
adjust
true.
rates.
For clarification, this shows cents per kilowatt hour. Can you help us understand how that number is calculated?
As I said, this is not a rate. The way the EIA gathers all this data, they look at the dollar amount of revenues we collected from all of our customers, all of our retail customers, and they divide that by the number of megawatts or kilowatt hours in this case that we put out to our retail customers. And that division, it's a very gross approximation, but it's a good way for utilities to compare one to another. We'll have different rates and different mechanism and riders, and it will be really hard to compare rate to rate or bill to bill, but this is a good way to, we all recover revenue and we all generate megawatts, so that's how it's calculated.
Great, thanks.
So within that calculation, then that's kilowatt hours generated or kilowatt hours
Provided to the, consumed by the,
just our customers, because they also do exports, right?
correct. So this is just comparing apples to apples. It is just revenues, retail revenues compared to megawatts consumed by our retail users.
By the customer.
Correct. To sanitize against the market sales and purchases and all that.
Yeah, Director Molhoff, it was a good question. I don't know if you want a longer conversation on that.
I just, that was something that kind of struck me in that OPPD workshop, that sometimes it's good to compare yourself to other utilities and sometimes it's not. And so we just want to be realistic on our.
We actually, a couple of years ago, had a big discussion about the selection of which ones are we going to use, and I think they've done a nice job now with selecting these. We did have a long discussion in the last year or two exactly about that, about the discussion, because we had a whole bunch, and I think they've really gotten a nice little cohort here for us to compare.
But, I still would be happy to renew that discussion a little bit
Yes.
relative to, where's the energy used most in buildings or industries or whatever, and should we be comparing how our customer makeup is there. But overall, gross measures, I think this is a good one.
Okay. Moving on, now I'm going to dive a little deeper. I'm going to go down into residential rates. Same graph, same comparison. We're at 5.3% below the regional average on these one. This is the one that there's more room for improvement than on the other two. As you can see, we're towards the bottom of the pack, but we're not as to the bottom as with general rates. There are states like Missouri and Iowa where for residential customers, we would like to beat them. We would like to get there and beat those statistics. So Nebraska is you can't see it. It's almost next to.
No, it's next, that's it.
Oh, this is Nebraska, I believe. Nebraska and Missouri, so the rest of the state. Now, when we're comparing to the rest of the state on retail, we are one of a few utilities that is a vertically integrated utility. And so our cost structure is a little different than smaller municipal. Not an excuse for us not to try to beat that threshold, but it explains a little bit of that difference. We are towards the bottom, not as close as we would like to be. And I think this is where continuing the cost and process improvement initiative, continuing to find ways to do more with less dollars will continue to be important as we move towards a more affordable rate on the residential side. Yes.
You just made about, like Directional just talked about, exactly, we're not ED, we're not LES, it's different things
Mostly,
going on.
we're not a smaller municipality. That's the biggest difference. We're not a city-owned or a smaller co-op. It's a little bit different. Still, I would like to be just as low, if not lower. This is an area of focus of mine. We will continue to move the organization towards.
The last slide was all rate classes. This is residential, so that would be all residential revenue divided by all residential retail sales.
Correct.
Leads to that 11.49.
Correct.
Great.
The next one, very proud of this one. Commercial revenue. All commercial revenue compared to all commercial megawatts. We are at the bottom of the pack. 9.9% lower than the regional average. In order for us to be any lower than the regional average, we have to beat ourselves, right? And so, which we will. We will continue to focus on doing that. But this is a really good visual of what we've done and how we've continued to optimize our system to serve commercial customers. They have a higher load factor. It's more efficient sometimes to serve those larger loads, and therefore we've been capitalizing on those opportunities to lower rates for this particular customer class.
I think it's worth mentioning every time we talk about commercial, if I've got it right, that commercial rates include public entities like schools and courthouses and that kind of thing.
Correct, and it is the least homogeneous group of customers. We have some a convenience store or a gas station. We have a large grocery store. We have a large school, hospital, and everything in between. And so that's the big category that covers all. This is over 46,000 commercial customers of all sizes and different industries.
Hey, Javier, on that one, so I see we just took over that role, it looks like, right? As being the lowest.
We have been in the bottom of the pack.
We've been pretty good.
But we have, and this is part of this is our no general rate increase, right? From 2016 to 2017, the fact that we didn't have to increase the revenue requirement has helped us because you can see that some others had an increase.
But I remember in the past, again, people were beating us up. Well, where's the public power advantage when we're trying to recruit businesses and all that, which I think been very successful with, obviously, what things have been getting. It's a whole regional effort. But that was a big deal not that long ago, 5-6 years ago. You're getting beat up. It's like, well, where's this public power advantage? Why don't we just sell it off? And
Still is.
So I'll touch on I'll touch on that point. Great segue, because the next one is industrial rates. These are even bigger customers. This is only about 150 to 160 large industrial customers, and same thing, very efficient load factor. We can put our system to use in a more efficient way, sometimes for these large loads, and we are towards the bottom of the packing here, competing with Iowa, trying to attract those businesses. To Director Molhoff's point, a rate's not a rate's not a rate. There's a lot underneath. You don't get the same reliability, you don't get the same resilience, you don't get the same customer service from all utilities, even though you may be paying the same dollar amount. So this is one where we have been very focused on maintaining our competitiveness and affordability without sacrificing reliability or resilience and things that are really important for our customers too. And the proof is in the pudding. I think we were very successful at attracting a major data center a couple of years ago. They just had their ribbon cutting ceremony in Papillion last week. And I would say, and they have said this, part of the reason they came is the competitiveness of the region, the rate and the service that they're expecting to get from OPPD. So as I've said before, I believe we are a big economic engine for the region, and this is one of the ways we promote that economic activity.
Javier, one could look at the residential, commercial, and industrial figures and quickly draw a conclusion, right, wrong, or otherwise, that residential customers are subsidizing lower rates for commercial or industrial. Could you address that?
Great.
I would say that's a segue into step number 2.
Great point.
Very reasonable.
No, residential customers are not subsidizing commercial customers and not subsidizing industrial customers. We have to go through a very rigorous process on cost allocation to make sure that cost causation matches the cost, the rate and the revenues we're recovering from customers. And this is not only just reviewed by our team, but we have outside consultants that always review these, and they present the assurance to the board that there is really no cross-subsidization between customer classes. All those investments, all those costs that we incur to serve industrial customers will be borne exclusively by industrial customers. Same thing goes to commercial customers, same thing goes to residential customers. In a super high level, without getting into much detail, the explanation here is, as I've said recently, commercial customers and especially industrial customers, I'll use that as an example. They're large loads, they're on almost all the time. Their load factors are up in the 90%, meaning when they open up a big factory, they will use 90% of the energy. They will use all of their energy 90% of the time. It varies very little. So from OPPD's perspective, or any other utility, when we go in and we install infrastructure to serve that customer, we know that we only have to install the infrastructure to serve that customer and maybe a little bit of variability if they use a little bit more power or a little bit less, but we know that they're going to be using almost the same amount of power 24/7, 365 days a year. That makes it for a more efficient financial framework to serve that customer. Now, on the other hand, you have a residential customer, a household, where you have working parents and children going to school. The usage on a residential facility is all over the place. High usage in the morning when everyone's getting ready to go to school and go to work, and then it goes down during the work hours. Now that load is shifted to commercial, and then when everybody comes back home, that load comes back up. We have to install infrastructure that is ready to serve the highest peak of that customer. Right? But that customer doesn't use all of that energy all the time. They use it just a few parts of the day. It's a less efficient way of delivering power. That is one of the explanations behind the differential between residential, commercial, and industrial. Doesn't mean that we're not doing as much as we can to bring that residential down, but that explains that load usage explains the different costs. But there is no cross-subsidization between those.
Thank you.
And I'd like to say, as a relatively new board member, the information staff has provided over the last 6 months to help understand that cross-subsidization and the different rate classes and cost recovery allocation has been extremely helpful. And I think I've mentioned before, but I look forward to that information being available to the public, because I think there's a lot of ratepayers who do not have the same amount of time that we have to sit in meetings at great length and learn all of those details. But I think that's really important that all rate classes understand how these rate structures work. I think in the past we've had some ratepayers who did not have the ability to understand where those costs come from and how they're being recovered. And so the information we've seen recently, I think, has been really, really tremendously helpful. And I think that more ratepayers having access to that will be great in helping them know the effort that staff and we're all putting in to help deliver efficient power and these low rates that are documented right here.
Thank you. We're working on that.
Thank you for mentioning those sessions. Just so the public knows, is that we've had 4 separate 4-hour sessions on sort of like the utility industry and OPPD, and we had one very, extensive session on rate discussion and everything. And everybody said, gee, how can we express this and give it to the public? It's easier said than done, but
we're working on it.
Mrs. Olson and
Boiling
team
down
are
16
working on
hours
this.
into
If you're willing to put 16 hours, and at this time, I'd like to thank all of the people at OPPD, the employees who were at all of those meetings. That took a lot of their time and effort and patience to explain all this to, because we had a lot of questions.
Well, we have Mr.
Really
Lenihan
appreciate
sitting
it.
here today, and we have Mr.
A
Underwood
lot
in
of
the
people,
back. and
everybody here is
a lot of
probably
other
doing
people
some of
here,
that,
but
yes.
it's their
Multiple
teams.
times, they're at
Yeah.
multiple meetings, yeah.
I wish you would have said that with a little more energy, like, we got the opportunity to have 4-hour sessions.
We did though. It was great. It was very, very helpful.
A little
and
fluff, sorry about
the thing
that.
is,
No, it's good.
I thought it was great.
I don't begrudge you that at all.
Okay, thank you.
Yeah.
I don't know if the employees got to say they had the opportunity too. They're not jumping up and down either.
They were
They put a
terribly
lot
excited.
Well, the thing is just the amount of
About the
preparation the amount of preparation that they used. I'm looking at Brad over there going, yeah, it was great. The amount of preparation and time that they did even prepare, and then discussion. It was
well
great.
done.
It was well done. Okay, that was a sidebar, but I thought it was necessary.
Next point, so in implementing the no general rate increase for 5 years and the directional target of 20%, we've also been asked to adhere to the following 6 principles. The first one is maintain fair, reasonable, and non-discriminatory rates, as stated in the Nebraska Revised Statute. And we have. And points of evidence here is that we perform an industry standard cost of service study to align rates with the cost drivers, back to the cost causation and cost allocation statement I made a few minutes ago. Those costs are allocated across the different classes, depending on their unique use. And we don't do these only ourselves, and we certify it ourselves. We actually bring in an outside consultant who is very well versed on rates and do these type of review for many other utilities to verify and keep us straight, make sure that we are doing what we're supposed to be doing and that we are providing fair, equitable, and non-discriminatory treatment to all of our ratepayers.
I have 2 comments on this one.
Yes.
How, are we doing that cost of service study annually, or is that done periodically? And then, have we ever thought of having a different outside consultant spot check?
Yeah. So the first question is, we do the cost of service periodically. We do today because we are in a no general rate increase environment for 5 years. We basically froze our cost of service from 2016. We're using that going forward for the next 5 years to keep the revenue requirement intact. However, we do an internal cost of service analysis to make sure that our actual cost of service is pretty much mirroring what we have in the 2016 cost of service. Make sure that we don't come out of the rate freeze window with a surprise, right? We're very much tracking that 2016 cost of service. Once we get out of the 2021 timeframe, we will then proceed with a more formal cost of service review. I don't expect it to be anything new because, again, we continue to monitor this on an annual basis. On the consultant, we do from time to time change consultants. We used to have a different consultant in the past. We've moved to the Brattle Group, is who we use today. There are competitive processes for us to review and go through these selection procurement of vendors. Last time the Brattle Group provided us a good bid, low price, great experience. I would say that they are, in my knowledge, the consultancy group with the most experience in the United States for these type of work. Doesn't mean that we will always stay with them. We will definitely periodically, put on an RFP and see what we can get. And this is something that the finance committee will be part of it when the time is.
If we used Brattle that long, it hasn't really been that many years, has it?
2014.
Okay.
That's what I was going to say.
And we've had a Brattle representative come, I think he talked to all the new directors and explained, and he gave the same in-service that we had last year, in addition to our other in-service.
Well, I think that was an improved in-service. I mean, it was
It was better.
201, right? It was
Yeah.
rates
It was
201.
201, yeah.
101 was
101.
in 2018, back in May.
201.
And you say that the next cost of service will be at the end of our 5-year period, so
Mm-hmm.
21 or so? Is that what we're thinking?
For going into 2022. And the reason for that, again, it's not that we're not reviewing our cost of service, we are reviewing it every single year, but in order for us to maintain the no general rate increase and the revenue requirement neutrality, a necessary step for that is to freeze the cost of service
The
we had in
baseline,
2016
sure.
and move forward for 5 years. We continue to do our own cost of service calculation to make sure that we're still tracking that 2016 cost of service, but it's not an official cost of service analysis. We'll do that when we get out of the 5-year period.
And the reason I asked that, that timeline is, I didn't go back and look for the comment or the slide, but my recollection of May 2018, rates 101, was that Brattle had referenced a letter, or it was in a slide, or made the comment that there are rates that are, or rate structure, either partially or in toto, that are out of date. So
I'm going to talk about that.
That's
you're going
next.
to talk about it?
Great, great.
That's next.
But I would also say, we do have a engineer, corporate engineer that does a review of whether or not, I know probably meets with Brad and the rates team on broadly around our cost of service, even though they're not a separate one to do deep dive on our work. Brattle really does that from the rates perspective, to gives that perspective, but then New Gen kind of does a broad piece about our investment strategy, our collection strategy, our rate strategy. We've done cost of service, so they'll do a variety of those kinds of related activities when we do our corporate operating plan.
Yep.
So
Doesn't the state agency that provides rating oversight, don't they require periodic?
no,
You'd like the Power Review Board?
Yeah, part of it works.
No,
That's
no,
us.
not on rates. It's really it's really the board's responsibility in that
responsibility.
regard.
yeah.
But I
That's
thought
why
they
we're
had
both
some
there.
oversight as far as to make sure that the rate structure involving comparing commercial to residential to industrial.
No.
Well, we're both a regulatory and
I
government.
thought there was a state.
Nope, it's us.
And my point in that was that because of these new data center, or this data center coming in, the percentage of energy used by one class compared to another will change dramatically in the next couple of years. And if we're not looking at that, I mean, we need to make sure that that continues to be allocated in a way that makes
Correct, and
sense.
that is being allocated to this. So even within the construct of the 2016 cost of service, we are using that construct and allocating costs in the same way. So if you have, for example, we have large industrial customers who require specific facilities that will only serve them.
Right.
Those costs are only paid by them. So even in the 5-year no general rate increase, we have a data center that's coming up online now. We are allocating those costs exclusively to that data center for those facilities that only benefit them. So we do have that mechanism to ensure that there's no cross subsidization.
Or
But-
if we have to increase production, those production costs would be
flows.
allocated
That's
to.
they have the
It
demand
flows
charge.
exactly the way, yeah. But to your point, I think as the industry changes and our customer changes, the relevance of our cost of service is even higher. We need to stay on top of it.
So it's not an absolute dollar amount cost of service, it's relative to what we're generating and selling.
It starts with an absolute dollar and the framework, and then we make modifications for these one-offs. If we have a big industrial customer, we don't have to wait until the 5-year rate period rate freeze ends. We can start billing that customer for that.
Right, thank you.
Okay, gonna try to move a little bit faster here. Equitably assigned costs across and within all customer
It's gonna get
classes.
very tested.
So I talked about the equitably assignation of costs across customer classes between commercial, residential, industrial. The other piece is within all customer classes. This is a graph that hopefully it's more familiar to the board now after the education sessions we've had. But what this does is says we have basically 3 cost components for an electric utility to serve its customers. One is the customer cost, the other one is the actual energy flow, and the other one is the demand costs. How much infrastructure we need to have in place just for the days or the times when you use the most energy, right? Whether you use energy or not, we still have to incur in demand costs. We have been successful, and we've been working with industrial customers in developing rates that accurately reflect customer cost, energy cost, and demand costs. This is part of our rate 261 and 261M. These customers have the luxury of, one, they're large, but we also have metering technology that allows us to very accurately know how much are they costing us from a demand perspective, from an energy perspective, and of course the customer side that doesn't require a meter. So we've been successful in implementing rates that equitably assign costs within that class. Industrial customer A versus industrial customer B versus industrial customer C, there is less cross-subsidization between those customers because we have rate structures and meter technology that allocate those costs directly to those customers. We've made progress in making the same improvement on both commercial and residential. But if you can see here down in the partial, we don't have today technology that allows us to collect demand information from all of our residential or commercial customers. We do have some commercial customers who have some demand meters, and for those we can pass that cost, but the majority of them we don't. And so part of the service charge increase for small commercial and residential classes was a step towards mirroring what that demand cost would have been. It's not precise, it's not super accurate, and it's something that we will continue to look at opportunities to get better information with different demand metering technologies so that we can then continue to make progress on more equitably assignation of costs, not only across customer classes, but within customer classes.
So Janice mentioned she attended the APPA conference here in Omaha. I just got back from the conference in Austin, Texas, and I did something like 24 hours of meetings and discussions about mostly rates. And there was a lot of discussion about, even within residential, how you can have different rate structures for different types of users, so specifically electric vehicles or distributed generators, and whether or not that is deemed, the terminology there, fair and equitable, and they indicated that yes, it is fair and equitable to segment out different types of users even within one rate class based on substantially different types of uses. Right. So electric vehicles and distributed generation were 2 areas there. And so, not a question right now, but I look forward to seeing rate design opportunities in the future where we can identify people who have different use types relative to those 3 classes and coming up with rates that help to meet their needs, which might be different than the other needs of people within those classes. And I think that's something that a lot of different utilities at the conference were talking about, how they are identifying where they're going to find new rate structures that most accurately recover those costs. PG&E right now is running tons of ads about their EV charging, both residential and fleet rate structures. And so there's a lot of opportunities out there. And I think that's a big area where, as we look at rate structure in the future, there's places where we can see some improvement.
Yep.
Would this be a substitute until you can get actually the accurate metering for this? Until you get something similar to an AMI metering to actually measure the demand charge? Would you need that type of rate if you had a demand charge structure in there right now?
You could have both. It's not either or.
You could have both.
The demand charge and the demand meter would aid in further segmenting different customer classes within a customer category. It's basically the fair, equitable, and non-discriminatory principle stands as long as you have like users. And like users define that not only the amount of energy they consume, but the pattern at which they consume it, right? And if there are significant differences in those variables, then you can make the case of, like you were saying, the example of an electric vehicle charging family would have a different pattern than a non-electric vehicle charging house. They may consume the same amount of energy, but the pattern might be different. So there would be conversations about is it appropriate to differentiate those, and if so, how do we go about differentiating those?
And we actually have a
two
pilot
rates?
though on the EV charging, don't we?
Not on the rates.
Not on the rates, but
Not
no,
on the
but
rates
as far
side.
as looking at the pattern, to look at the pattern
Sure.
of what the pattern is right now,
At-
not on
at
the
the
rates. though.
residential, not at
At the
the commercial
residential,
fleet
but not
level.
at the commercial, yeah.
I mean, commercial fleet offers an opportunity, and back to PG&E, that's what they're doing. They're advocating pretty heavily. I mean, they have an on-staff person who helps commercial enterprises adopt fleets of EVs. So, yeah, but to your point, I think,
Yeah,
back to the term.
I'm trying to figure out, which goes first. Do we do a rate like, like Eric has suggested, or do we put in the metering that's necessary to do it? And what's the cost of that? It also is cost. What's holding us back now is cost of technology and state of the art. Am I correct?
Yeah, well, my comment to your question, and then maybe, because I think I'm adding on.
Yeah.
Is, out at Stanford, the Precourt Center for Energy has a bits and watts program. I mean, it's no longer just watts. It is about that transfer of information and what our vision is for the utility of the future.
Right.
So I think your
It's a
question
lot.
is right.
What comes
You got to
first?
have both, and how do we make it happen?
How do you make it
I'm
happen,
looking
and when
forward
do you
to
make it
hearing
happen?
how that goes.
We're only halfway through this right at this point, but we're gonna have those conversations as we get closer to rate setting.
Okay.
We're just doing some reviews now, not to shut it down, I'm just telling you time-wise,
you're
we're
so
only halfway
good, yeah.
through this. I know
That's good, yeah.
it's on everybody's mind,
It is.
but,
Yeah.
those conversations
We're so eager
would
to jump into
be
it.
at the retreat in the fall and anytime in between.
I'll push back just a little bit. So this
We need
is
to have this for the
this is a
public,
chart
too.
we saw during those 14-hour or
Yeah.
4-hour sessions. And so this is one of those opportunities
For the public to
for
look
the
at it.
public to kind of internalize
Exactly.
what
The
we
public needs to
get.
look, listen
I'm
to
just-
that right
yeah,
now where we are.
I don't mind, I'm just telling you, we're
Yeah.
halfway through the
Thank you.
proposal. It's like, it's your time too,
Yeah.
so.
But,
Fair.
this is
But-
going
Yeah,
to be
no.
repeated, this is also going to be repeated, at the board meeting too. But,
This presentation.
Not this
No.
presentation.
This is not.
Not this
No,
presentation?
no.
Oh, then I don't mind expanding this a
yeah.
little bit. I think it's
I
important
don't
that
mind
the
either, I'm
public sees
just
this.
letting you all know we're halfway through, so.
I don't care.
Okay.
Yeah.
Okay.
For this is important for the public to understand, yeah. Okay, would you like to comment on that, Javier, just a little bit, as far as what you...
What's preventing us
what we
from doing
just
these?
talked about as far as the...
We're evolving. I truly believe, and I know it might be controversial what I'm going to say, but I truly believe that we are leading the way we power the future. We have been criticized many times for implementing this technology, for implementing this type of rate design thinking, because it's a change from the status quo. What's preventing us from doing this is one is technology is changing. We want to make sure that we have the right technology, that we're investing in the right meter technology, and that we have the right information. Our generation is changing, our transmission is changing, our load customers are changing. So some of those things, those changes are not minor. And so we want to make sure that we're careful about how do we make these changes, and that we don't change rates or rate structures too fast every year, because it would not be palatable for our customer owners. The other piece is we need to be very much aware of our customer owners. And I'm going to talk about affordability. The majority of our customer owners don't care, don't know what the cents per kilowatt hour they're paying. They care about the dollar amount in their bill. And so how fast we move to different rate structures, what the logic we have behind it, and the vision we have for OPPD in the future is met with the reality of the mom and pop sitting down at the kitchen table, writing down the check and paying that bill. So I think that's the other piece, that it's not only what we can do and how fast and how the technology we can implement, it's how do we make it in a way that it's not too disruptive to the customer owner. So I think that it's a tricky...
I would say,
tricky, yeah.
you're going to be hearing the conversation, and we're going to be presenting to the public as well as the board on Thursday about some of these strategic initiatives that will line up with some of this conversation. And so whether it's on customer engagement and research, whether it's on our digital and operational automation technology on the distribution side, or our technology inside the organization, and how that may impact customers, we're going to be spending over the next 5 months, including this Thursday, and then 4 months after, to do deep dives on these strategic initiatives that begin to line up with a lot of this conversation. To be able to give the information from what customers are saying about what our needs may be on the operational side for reliability, resiliency, and what that future generation may look like. Really, information to the board so they can make the best decisions as we move forward. And we will begin to lay out very clearly what the future of, we believe, OPPD looks like in the future. And so we'll be doing that on Thursday. The board's had a precursor of that and has seen that, and we'll have that dialogue on Thursday. Is the intent is to present that at the board meeting after the president's report on Thursday. And I believe the board will be getting a copy of what that presentation looks like very shortly here, if you haven't received it already in diligent. But and so you'll get to see what that looks like going forward. So it's within the. We're thinking about the same stuff. We just want to make sure that we do it in a very planned, methodical method to be able to get there. So we can get there quick and we can get there relatively stably in the process.
I really appreciate the future thinking conversation. I just want to remind everyone again, just on this monitoring report, what we're asking the board and what the finance committee has reviewed and approved. It's have we done what you've told us to do these past years? So it's a rear view mirror. It's something that I have to keep reminding ourselves. Great conversation going forward. Lots of good opportunities. I'm going to continue to focus now on the next few slides on the past. Where are we and how we've executed, if that's okay. So going into affordability indicators, we're evolving on these. We presented some affordability indicators last year. These are a little bit different, and I've gotten feedback from some directors. Director Yoder was very helpful in helping us think, how should we measure affordability? Affordability is in the eye of the beholder. However, there are some statistics here that I think speak well for affordability. This graph presents the average residential bill, not cents per kilowatt hour, but the total bill, residential bill. For OPPD, that average residential bill was $103. That's 3.7% below the regional average. And it matches the residential lines that I showed earlier with the cents per kilowatt hour. We're on the lower side of the pack. There's room for us to improve on the bill as well. Something that doesn't match necessarily, it's the states. We used to have Missouri, I believe, down here. Now it's Minnesota. But we still continue to be at the low end of the pack.
Just out of curiosity, when I looked at the average residential cost per kilowatt hour, Minnesota was on the higher end. We have any idea why they're on the lower end when it comes to cost per?
I don't have an answer.
Does it have to do
for
with
you.
their income?
I can follow up with you.
This is the average.
That's the average bill, affordability. Yeah.
There's not necessarily a subsidization. Part of it is it's also a conversation that we've had here in previous years. Who are we comparing ourselves to? And when you have states that are really cold and use a lot of gas generation for heating versus states that are more on the warmer, more humid, and they use more power during different times of the year. So, but I don't have an answer for you all. If it's okay, I can follow up.
Yeah, sure. Yeah, just curious. I'm sorry, I missed that.
They have access to hydro coming down from Canada.
Okay.
And that provides them with some differences than what we have.
Yeah.
$103.82, the average residential bill. How does that compare to the rest of the nation? If I hope you can see here, if not on your diligent slides. This is OPPD, this orange spot here. The average bill for the state of Nebraska is $105. The average bill for the West North Central region is $108. There are certainly states and regions that have lower bills. I don't have an explanation for each one of these states. We can follow up on you. I think one of the things that I'm pleasantly surprised, having moved from the Pacific Northwest not that long ago, with access to really low-cost hydropower, is that our rates, our bills, the size of our bill is not that different than those over there. So we're doing well. Can we do better? Yes, and we will continue to strive for better. But from a national perspective, having a $103 average bill where the region is at $108, just south of us, the averages are in the $115, $116, right in Kansas and Missouri, $115 in South Dakota. I think it speaks volumes to the public power state we have in Nebraska, and two, what we've been doing to keep our bills for our customers as low as possible.
And when people, when mom and pop are paying, you're writing that check or budgeting for the future, that's what they're thinking. They're thinking of the bill. They're not thinking of the rates per kilowatt hour. So I think it's a good way to frame this issue for folks.
Yeah, and they also want stability, right? They want to know that next year, as they're planning their budget, their utility rate or their utility bill is going to be similar to this year, or some stability. And I think that's what we're providing with that rate freeze.
Hey, Javier, I looked at West Virginia. Am I reading that correctly? Does that say they're paying $19 a month?
119.
119.
Does that keep, it is.
119.
Yeah, it didn't show. It was
Okay.
all there.
Okay, I'm sorry. Jeez.
The advantage of digital.
Yeah, that's part of the. Okay.
You can do that.
What have our statistics done in the past? This is the same statistic, but it's the electricity bill as a percent of income. So our $103 bill in 2017, what percent of disposable income does that represent for our customer owners? This is important because it's only electricity bill. Sometimes when you see energy bills on statistics, that includes electric and gas and transportation. So we've sanitized all of that. This is just for the electricity. We've been making headway, either by lowering the bill that our customers pay, and or by increasing their purchasing power. So both disposable income has either maintained or grown, and our bills have maintained or declined, and that is what explains this declining line here. There are states that are better than us. In Colorado, this statistic is 1.3%. Their electric bill is 1.3% of their disposable income. There are states that are significantly higher. Mississippi, 3.5%. The bill might not be that different than ours, but their disposable income might be different than ours. So that's another metric of affordability, not only the electric bill, but how much does that compare to your disposable income as you're writing that check.
So when we use this as an affordability indicator, both energy consumption and bill cost in total and income vary by household. And it has been, and they're not directly correlated, which we've talked about a number of times in the past. But there is some level of correlation between energy consumption and income. And I think this is one of the things that we need to use to determine whether or not SD2, we are meeting the objectives of SD2, and whether or not SD2 needs to be updated in the future is what impacts do our rate structures have on people across all classes in our district. And it has been highlighted also that the rate restructuring that occurred did cause varying impacts to varying people within the residential class. And so I ask now because as we evaluate whether or not we're meeting the objectives of SD2 and in the future whether or not SD2 needs to be updated, I think this is an extremely important metric, recognizing that neither consumption and bill nor income is uniform across all of the ratepayers in our district. And that's not currently reflected in SD2, and we've talked before about what is or is not allowable under state statute, but I think it's something that we really need to strongly consider as we determine whether or not our rate structures, particularly in the residential area, are meeting the best needs of the people in our district.
Thank you. Just to remind, one of the points that I mentioned earlier,
Correct.
future discussion, right? And one of the points that I mentioned earlier, and I want to be crystal clear here on the monitoring report, looking backwards, it's the board has asked us to equitably assign costs across and within all customer classes, and that's, as I've presented, we believe that we're delivering. Now, future direction and policy, that's for you to debate and decide in the future. But
so to that point, and to what Tim said earlier, I'm not sure how governance is capturing the topics or what comes up in this what's
We're gonna be talking
happening
about
later on.
this afterwards. You know, at the end of this, we will bring this up as far as talking
Okay,
about
but this, I mean, this is something that,
I think
yeah.
everybody knows that's on the list.
Okay, all right.
Okay. I'll move here. This is another map showing that electricity burden for OPPD in particular is 1.9%. State of Nebraska is 2.11%. So we're better than the state of Nebraska, partly because we are concentrated in a region of the state that has higher income per capita. But you can see how we compare to the rest of the
Yeah,
nation.
there'd be variance across different districts within OPPD.
And across different states, as you can see.
Everywhere.
Yep.
Yeah.
Okay, moving on, just a point of clarification here. The mean is $103 of the electric bill. That's the one that I've talked about before. The median is 101. That means that 50% of our customers pay $101 or less. And it's actually more than 50%. 51% of our customers are paying $103 or less. Just for those who like statistics, this is important. We pursue rate process and structure changes to reflect the cost of energy when it is used. We have a time of use rates available through general services, the time of use rate rider 469. That's not to say that there's not a lot of opportunity for us to continue looking at other time of use rate structures, but we have started to respond to time of use rates with rate rider 469. But probably the most important here is what Director Mulhoff alluded to earlier, the FPPA base rate and the fuel and power purchase adjustment clause. It allows us to pass on or modify the cost that we recover to customer owners on a timely manner, either upward or downward, based on the cost of our fuel or our purchase power. And so it's one that allows us to pass that on, that cost with the energy is used with the current cost of that energy.
So, to that point, we mentioned this a couple of times today. Help me with my recollection. Last year, didn't we choose not to pass that cost along, and we chose to take money internally and make up that difference?
Part of it, what happened last year is the formula of the FPPA is, I'm just going to say, it's not perfect, and so what the FPPA captured increases in purchase power that we made in 2018. It did not capture, the formula is not designed to capture revenue that we capture also from the market. So the big part of the discussion we had on this topic a few months ago was asking the board to forgive that increase in the FPPA because there was an offsetting revenue that was not part of the formula that really made the district whole for the most part.
Thank you.
Yeah. The next one is we offer flexibility and options. Again, this is something that we continue to explore. Julie's team with our customers are looking at what other options we're offering. We have a flexible by technology. We've implemented LED street light rates. We have the community solar rate, heat pumps. And we have also optionality for different customers who want different variations within their rates. 261M comes to mind, and irrigation. There's more here. This is not an exhaustive list by any means. This is probably ever evolving. But I want to remind the board that we have been, you have been making decisions. You have approved LED street light rates. You have approved community solar rates in response to flexibility and options that are being demanded by our customer owners. So this is part of demonstrating that we're providing that flexibility and that option.
And Eric, your comment about the different rates, I think this is where this goes as far as in the future, as far as looking at that. And what's great now is we have Julie's team that is on full board. That will help us in the future, and I think will also help us with the strategic directors and all of that in the future. So I think we've got a positive forward motion, rather than we're not stagnant in this position right now.
The last point here, and going back to Director Yoder's comment earlier about the rates not being easy to understand, or that there was some rate language that was old. Be simple and easy to understand. This is, again, on the eye of the beholder. It depends on who you ask whether they're simple and easy to understand. What we launched this year, it's a cross-functional effort between public affairs, corporate communications, our customer service team, and my team in rates. we've launched a team, we've tasked them to review the 120 plus page rate manual that we have online today. And that manual has been growing through years. And take a hard look at it. Is it simple? Is it easy to understand? Is it standard? Do we have the same type of language, the same type of layout for all the different rates? Is it confusing? And if so, how can we clean it up and make it easier to understand? I am very pleased to just share with you, we've already seen some of that work product. The team went out and they benchmarked. They benchmarked with many other utilities. Some other utilities have about the same number of rates and rate writers than we do, but the rate manual is 400 pages. So our 120 pages looks a little bit better than that one, but we've actually been looking at language and format, and the team has been finding a lot of opportunities for us to clarify. This is going to require board action because it will be changing the rate language. It will not be changing rates in a deep dive manner on rate structure or the type of rates. It's mostly of a grammatical cleanup, formatting, but we believe that this is part of us responding to the directive of we need to have rates that are easy and simple to understand, yet comprehensive enough that it gives our teams enough information on how we charge for their services.
Yeah, the timeline is at the end of this year? Is
The end of this year will come, so the typical cycle for board approval of rates typically comes at the end of the year. We're expecting some work product here in the next month. For senior management, we'll refine it, we'll send it back to the board, to the team. It'll be shared with the board towards the end of the year for the rate approval at the end of the year.
Typically around the October timeframe, the board would have the opportunity to kind of see that as we preliminarily do the corporate operating plan, at least in that conversation with the board. And then we'll come in November and have a 30-day period, and come in December and actually approve the corporate operating plan that will have.
And any rate
changes. Any rate
And
changes.
to clarify, this doesn't have to do with what the board's role is as far as rate design. This has to do with just these regulations that they're looking at. We have to go back at a separate time if we so desire to look at rate design, like you talked about, Eric, like the service charge, that type of stuff. Even though are you going to bring up the service charge at all on these service regulations?
No, because that would be a significant change on rate design. This is
Right.
the scope for this group
verify
is
that.
clean up, standardize, modernize language. Make sure that when we're talking about one rate, you can compare that one to the next one, and give customers more clarity about which rate they want and how it's going to affect their bill. It's not affecting fundamentally the way the rate and the charge is working. There might be one or two clarifications that might be a little bit more disruptive, but the majority of them are grammatical.
Some of this is born out of feedback we got through the customer experience strategic initiative on what was easy to understand and not easy to understand. And so we've taken it from that lens of, from a customer's perspective of reviewing or reading these rates and how it applies to their bill, trying to clean it up and make it more understandable from that perspective.
Good.
So as far as any comments about rate structure, what is the process we should use on that? I've heard, and I think other directors have heard, specific comments on specific rates, not the broad residential category, but smaller areas where there are changes that have been requested or updates that might help people to determine how they purchase energy or energy services from us. What is the process by which that might be considered along with these other grammatical changes?
So in the example that you're giving, I would say it's a customer driven. Right? If you have customers that desire certain rates or modifications to certain rates, it's a customer satisfaction piece. Our team, our rates team, can design rates all day long, but that's not going to be useful unless we know what the interest is from the customer. So this is where the PI committee, I would say, as responsible for customer engagement and satisfaction, that's where it would start. We would start the conversation. You would determine whether there's enough interest, how would this affect certain customers or others, and then the rates team and the customer team would come together and provide solutions for that.
Can I build on that? Because as you know, we had a rates discussion in our PI committee meeting, which I'll talk about maybe in about 4 hours. I think starting through the PI committee, as Javier underscored, if it is truly a customer-driven concern, then that's what our job is as a PI committee. And I think what I'll report on later is that those that we identified during our committee meeting, the pathways for each of them and the pace are dramatically different. So I think we just kind of need to get it on the table first.
Right.
And then we can kind of step back and go, okay, is this something that can be addressed in, a year, 5 years, or whatever the time frame is, and then that's kind of how I think we envision that's going to go forward, because different people will need to be at the table for each one.
Great. Look
And
forward to
I
that.
think, and to try to figure out that all the board members can sort of partake in that too, as
Absolutely.
far as reporting, it's going to be an interesting, I think it's not an easy fix, is what you're saying. It's a long-term strategic plan as far as what the board has got to sort of plan out, as far as, first of all, what they want, identify what's the quick, are there any quick fixes or not, which there might be one, I don't know.
Yeah, we'll talk about them
Maybe a
later. I
couple
think there are
we'll
some
talk
that are going
about
to go a lot
later.
quicker
There's
than I
some
think we
quick
thought.
fixtures, and there's some long-term fixes.
Quick, and just a quick point of clarification. That is not, in my opinion, that's not the only way, but given your example, that would be the way to do it. It could be also that from the finance side of the equation, we may be noticing that certain usage patterns, certain load forecasts are not necessarily matching with what the rate should do. Those would be generated, initiated from this side, from the financial and the rates planning side, and it would be then shared with the PI committee. But that would be something that is born out of misalignment with what the rate was designed to do and load and behavior, not necessarily about the customer asking for that, but us making sure that it's doing what it's supposed to do.
Great. Thanks.
And that concludes this monitoring report, unless there are any questions.
I have a comment. I think this is terrific. Looking back over the last reports, I think this is much more detailed, much more in depth, giving greater context. I just, way to go.
Thank you.
Thank you.
Thank you.
All right, so this is an action item on the Thursday agenda, so we'll go from there. That's it. Want to take a break?
Are you sure?
That's
I did, what we're going to do, I think we are going to order some cold cuts or whatever, because we have a feeling this, it's not going to go to 4 o'clock, Director Gay, but maybe 2. Or is it you? So why don't we continue, what's the next thing on the agenda? Let's see. Nuclear? You want to take a quick 10-minute break? Everybody can stand up, because we've been going for an hour plus, so.
Good?
We're good.
All right.
Okay, we're good. Okay, next we have nuclear
Systems committee.
and systems management, yes?
Sure.
Both?
So I just wanted to convey to everybody that the systems committee, rather I, as the systems committee chair, has talked with each of the other board members on the systems committee and about potential revisions to SD7. I've gotten good feedback from that. I'm writing that and should have a straw man available that I'd like to introduce to the other board members.
Okay.
And other management team members of the systems committee. Here in the next week or so, I think I should have some language, some straw man language on changes.
Has the other systems committee members participated in this?
Well, board members, I've talked with them about that, and yes, they've given me feedback on that.
They have given you feedback on it?
Yeah.
Okay,
So I'm having those conversations,
okay.
just to let you know.
Maybe you can have a conversation with me too beforehand. Do that too. I'd
Happy to
appreciate
do
it.
that.
Yeah, thank you.
And the other board members, and the
Yes.
other management team members on systems. Anyway, so with that, a little bit of hesitant explanation, I'd like to ask VP Fisher for an update on nuclear.
Just a quick update on nuclear. The nuclear team continues to perform well. The leadership is really focused on contractor management in terms of the engineering work that needs to go on for the dry cask movement. We are proceeding forward. I believe we will be on schedule to go ahead and start that work later this year. And we're just making sure that we're doing all of the preparatory work that needs to be done to make sure that we meet that schedule. Along that same line, there is a construction the board approved about a year ago for a new independent spent fuel storage installation security facility that the construction schedule would start in June. We're pushing on that due to the floodwaters, but I still believe that the end date will not move. So we're doing some mitigation work up there right now. I'm not really about floodwaters around where this facility would be built as much as it is just the groundwater level has risen so much that it makes construction difficult. So we're working towards that, and I believe that the timeline will remain, the end date at least will remain the same. And then last but certainly not least, our decommissioning contractor and the agreement that we have with Energy Solutions that's in place, as the board is well aware, moving us from safe store to decon or decontamination of the facility. We're bringing that contractor in. I believe that's going very well. The contractor has really stepped up and brought in a lot of knowledge and expertise that we are seeing is going to be very helpful for us going forward in terms of planning how we're going to move into deconstruction. Last but certainly not least, we have a nuclear oversight team at Fort Calhoun. Their role is to remain independent from the operations and to assess how operations are going. They report directly to me and have a direct line to Tim Burke should they need to do that. And they continue to report that the site performance is going very well. They are also the ones that have been down doing the monitoring, the tracking, and the review of how our contractor is doing and building the cask that we need, the canisters specifically and the baskets. That fabrication, as we've talked about before, has been trailing behind, but I believe that it is now moving in a direction where we feel like it's going to be successful and meet the time requirements that we need to start moving fuel this fall.
Just a quick thing is there a monetary penalty if the timeline isn't met on that?
There are liquidated damages, but it's tied to the delivery of the cask, not to the fabrication.
Okay.
And so they do still have time. And I believe that, as we talked about before, they were putting in recovery plans. I believe that those are going well now. And so I believe that as of right now, we're feeling a bit more comfortable that we'll meet those time requirements.
Thank you.
The last thing that I want to mention is that our nuclear oversight team also does vendor surveillances, and they've been doing a number of those just to support what's going on the nuclear side. So while we are moving away from many of those programs as becoming a decommissioning entity or a decommissioning process, we do still have specific things around the spent nuclear fuel that require vendor audits, and so they continue to do those, make sure that we're meeting all the qualifications necessary going forward. So they're quite a busy group at this point in time, making sure that we have all of those things in place before we would get into our spent fuel movement activities later in the year. That concludes my report.
I understand. Thank you for that report. New subject related to Fort Calhoun. I understand the new board members will be visiting. Is that right?
We have set up tours, yes, so the new board members will be visiting.
Okay.
To the extent it's accessible, I mean, we are making, I'm sorry? Sure, oh, sure, yeah, yes. And I think the independent spent fuel storage installation is obviously something, and we've talked about the weather needs to be good to support that. But if we don't get it done, in July, we'll move it out to August and find a day where it's going to work for everyone.
Thank you, I'm looking forward to that. And when is the next NRC meeting?
The exit is on August 1st, so it starts earlier, 2 or 3 days earlier than that. So the 29th of July, I believe they come in, and they will exit on the August 1st at 8 a.m.
Okay.
I will be out of town and won't be able to make that. But other board members are certainly encouraged
I will be there.
I think there was an invite sent.
There was an invite sent, yeah.
Mary, any meaningful changes in staffing? Are we pretty?
So I have a staffing report. The thing that I found interesting as I looked through this, and I was thinking back in June of 2016 when we made the decision to shut down Fort Calhoun, we were at a little over 700 people. Today we're down to 271. So significant movement of personnel. But the thing that I thought was really strikingly it was striking to me as I kind of reviewed that this month was that we have had more resignations, retirements, and transfers out than we've had layoffs and terminations. So I can give you those numbers. The resignations were 153, the retirements were 78, transfer outs were 80. So that's people coming in to the greater part of OPPD and then into the district to help support operations here. But terminations have only been 67. So even though we've gone down, a little bit under 500, we've really done it in a manner in which we set out to do. And it's really a tribute to Martin and her team in helping us to accomplish that.
Great. Second question. There's a nice but brief article in the World Herald recently about all of our great efforts out there, which is nice to have them paying attention, quite honestly, to the work that we're doing. It just generically said that there were savings as a result of going from safe store to deconstruction, but it didn't specify a number. Are we able to share kind of what, over the course of the entire project, what our ballpark number for savings is by making that shift?
Yeah, we did that when we made the decision to move
Yeah,
there.
that's
And
kind of what I thought that was.
we still are estimating close to or up to about $200 million of savings. So we did make that public late last year or in the kind of August, September timeframe last year. And then as we've moved forward in getting the contract set, we've said that a number of times. So
Yeah,
certainly.
I thought so. That's why I was surprised that a number like that didn't actually get printed. But whatever. Okay.
I would just like to thank Chris Averett and Jody Baker
Chris
for
did a
all
nice
the work
job.
that they did on that, because it took
Yeah, I'm sure.
several weeks and months.
Yeah, you would think that she would have gotten that number down on there when I asked her the numbers. I said, do you have all the numbers? She says, oh, yeah. I said, okay.
All right. Thank you.
Thank you.
Yes.
Yeah, Chris is in the back there. Hi, Chris.
All right. Any other questions? That's it for systems. Thanks.
Okay, next we have, we're going to go through governance again. No public information.
Was governance?
There's
in
two
there?
items
governance.
under
We
governance.
do have some of governance. Oh, yeah, we do have 2
Yeah,
guys.
this is like the second playing a double header, like a day-nighter, you know, this is like, this is part
Yeah,
of
but
it.
since we had governance at the closed session meeting, yeah. I said, oh, yeah, we do have one thing in governance that we can talk about, yes.
The Governance Committee met on Tuesday, June 4th, and discussed the following items. Claim settlement in excess of $50,000, which we'll get a report on here in a little bit. We also discussed corporate officer compensation adjustments, which will be on the board, on the agenda for Thursday as well. We also discussed enterprise risk management. We had a quarterly update. And we also discussed the SD-15, which is the Enterprise Risk Management Monitoring Report, which we will receive today in a little bit to see if we're in compliance with SD-15. We also discussed strategic initiatives, the upcoming board governance workshop, which is still scheduled for Thursday, August 29th, as you're all aware. And we also discussed meeting logistics. Management discussed proposed reminders concerning Open Meetings Act and Director of Fiduciary Responsibilities. That was an interesting segment. Anyway, on today's agenda, we have the first item we have is we have a reporting item followed by an action item, and the reporting item is claim settlements, or actually one settlement in excess of $50,000. And Scott, do you want to take that?
Yeah, sure will. I introduced Lisa Hutt to you earlier. She's sitting over here, and just to wave so you know, her and her team do a great job of managing claims, both with regards to claims of property or other things that may be driven by OPPD, as well as things that happen to OPPD's property. They do an incredible job and are incredibly busy, always on working and serving on behalf of our customer owners, and we're delighted to have her and her team. They do an amazing job. Nebraska Statute 84-713 does require that we report back to the board any claim that is incurred in excess of $50,000. So this is simply really a reporting item regarding one of the claims. A telecommunication company submitted a tort claim to the district in connection with a damaged fiber cable located on the southwest corner of 80th and Harrison. The district was installing new poles along Harrison as part of a transmission project when a fiber cable sustained damage. The claimant's claim exceeded $76,000. One of the reasons I bring up Lisa and her team is the district and claimant agreed to a settlement in the amount of $62,000 without any admission of liability by the district. The parties have entered into a written settlement of the claim. Again, this is just a reporting item. It is driven by statute, and I don't know if there's any questions regarding this, but we'd be happy to take them.
Sure, I'll ask the question. And I understand that there's a negotiated settlement here, so I'll try to be careful. But were there any was it incorrect information maybe that led to this, or?
Yeah, I would say there's a couple things that was tied to this, and a couple of it was the way they were doing this project is they were kind of forecasting in segments to do line locations, and there appeared to be some communication miscommunications between project managers of the different line locating utilities. And we also had kind of a crew leader change from a crew leader to an acting crew leader, and there was some miscommunication, I think, in that regard that we could have done better. And so I think this information has kind of been documented, shared certainly within the T&D organization. I know Dan has heard this at his staff meeting, and Lee O'Neill and the team are cascading that kind of information, make sure we do a better job of turning over on these kind of projects. And so it's just a good indication. This could have been, it's one we did not identify as a SIF originally until it came to the senior management team, and we identified this as a serious or potential fatality incident where we could have dug into a natural gas line or had some other impact there. And so Kevin's team began to look at this as a SIFT, and there'll be some action items that'll come out of that as well. So,
so you're looking at processes,
absolutely,
and taking corrective actions. Great.
Correct. Yeah.
The
Thanks for the
information
question.
provided through this Director Yoder is very helpful in lessons learned and figuring out how we can drive operational excellence and continue to improve the operations in the organization.
Thank you.
Okay, thanks, Scott. Our next item, again, is a board action item. It's an examination of SD 15 energy or enterprise risk management report. Today's action is to ensure compliance with the existing policy. Again, Scott, you want to go ahead?
I'm happy to for this one. Just like Javier, I'll stand up in front. It is always a pleasure to walk through kind of the progress of the past year where we have. I do believe that this is a little bit easier and perhaps in many ways less robust for discussion because it really is about setting up a system and actually demonstrating that the system is in place. High level SD 15, you see it here. OPPD shall maintain an enterprise risk management program to perform an independent oversight function of the district's risk management activities, to ensure significant risks are identified, assessed, managed, and reported through organizational policies, procedures, and processes, to maintain risk exposures within agreed-upon risk tolerance levels. The Board of Directors shall ensure the district is maintaining an ERM program that fulfills this policy. Review the district's most significant risks on a quarterly basis to validate assumptions and assess the impacts of changes since initial risk review. When necessary, request additional explanation of the risk from the corresponding vice president or senior manager responsible for the risk, or request additional expertise to supplement the review. And finally, to review additional ERM information, related risk activities, and strategies on an as-needed basis. This policy was initially adopted July 16th of 2015. It has been reviewed and some minor changes have been made over the course of the years. The most recent one was in April the 15th of 2018. This highlights the system. Ultimately, we want to make sure that we have a risk kind of governance approach and system that allows us to, in a timely and effective manner, identify, assess, manage, and report all risks. We follow the ISO 31000 model, which provides guidelines, principles, framework, processes that help us think through how do we best do that. And we assess on a regular basis how we're doing with regards to that and also the maturity of our risk model. To kind of read this, I think it's important to talk initially from bottom up. The bottom highlights the fact that we have 3 enterprise risk committees, the Governance and Public Information Risk Committee, and you met, I introduced Joe Lang earlier, and he's sitting over here. He's chair. He's also, again, Director of Compliance in the RTO. Finance, you saw Laura Langford earlier this morning, who's Director of Corporate Accounting. And then System Management and Nuclear Oversight, and Brad Underwood, who's Director of Planning and Analysis. For each one of these committees, there's at least one representative from each business unit, so that we're ensuring a cross-functional and rather independent review. Each one of these committees meets on a monthly basis to discuss risks and to make sure that all risks are reviewed on at least an annual basis. Depending on the risk, depending on dynamics in the risk itself might be reviewed more frequently than that. There's a risk matrix that's used to consistently evaluate risks across the district. It's interesting, as we talked about risks a little bit earlier, you see the risks come from different areas. It's really important that we have a common language and a filter through which to look at all of the risks so that we can kind of understand and present them and discuss them as a book, one relative to the next, in terms of having common criteria through which to filter those. Significant risks, those red ones, are reviewed by the board, and the next red as well as the next level, orange, are escalated quarterly to the board or to the senior management team. So there is a quarterly review. And there's also a standing agenda item for the risk committees to also discuss any emerging risks. Because as we know, yesterday's risks might not be tomorrow, and tomorrow's risks might not be identified today. So we want to make sure that each one of these committees has an opportunity to have a regular recurring conversation, again, ultimately to identify, assess, manage, and report on the risks. I'd mentioned earlier that board policy, SD 15, guides this. Again, earlier, the SD15 asks that we have organizational policies, processes, and procedures in place to guide how we approach it. SD15 is certainly kind of a foundational component. We also have the Enterprise Risk Management Policy Guide that spells out very clearly policies and procedures for managing the risks. With regards to risk identification and oversight, I mentioned again that all three of the ERM group committees meet monthly to identify and assess risks and at least have one member from each of the business units, so there's cross-functional representation. And finally, again, on a quarterly basis, the most significant risks are elevated into the organization, and we have, I think, very robust, insightful, and deep discussion around those risks, again, to ensure that there's a conscious awareness of the risks and that we're providing assurance to the organization in terms of our ability not only to identify but to manage and to mitigate those risks. I had mentioned again that we review the district's most significant risks on a quarterly basis. This just highlights the fact that indeed those quarterly reviews have taken place. Third quarter took place September 11th, 2018. Fourth quarter, December 11th. We had a very abbreviated version on first quarter in March 12th. And then, of course, this morning in closed session, we had that. These meetings are in closed session because, again, it's risk, and we want to make sure that we're able to have the right kind of transparency and discussion and control the information so that we're not sending information that would be and should be confidential going out more broadly than we can intend or control. When necessary, you can request additional explanation of the risk from the corresponding senior manager responsible for the risk, or request additional expertise to supplement the review. I want to highlight a couple of things here. It's important when we think about creating a risk culture in an organization that we have very clear roles and responsibilities, that we have people that are, I would say, the first line of defense who actually own the process, that are actually identifying and aware of and seeking to manage effectively the risk. So we have the subject matter expert. We have a direct report. This is somebody that reports directly to the senior management team that's actually an owner. Their accountability is to make sure that the processes and things in place really are effectively managing and mitigating those risks. And then ultimately there's a senior manager owner. So as you saw this morning in closed session, each one of these vice presidents is connected or associated with any number of the risks that we have so that we can ensure that we have the right kind of oversight. At any point in time, you as a board, of course, can approach, discuss any of these risks. Certainly if there's risks that you're wondering about, there was a conversation earlier this year regarding wildfire, which led to additional conversation, and then you were able to see the risk group kind of get into action and come back and provide some kind of a report. Also, finally, then, review additional ERM information, related risk activities, and strategies on an as-needed basis. We leverage ERM during our strategic planning discussions. Javier had mentioned earlier today how we use ERM or risk management really to help prioritize and support resource allocation decisions, and especially in terms of capital project prioritization and other types of resources. We guide and tee up decisions in the organization using something called a business decision model. Within that model, there's risk information, and so it's always inviting people to have a conversation to identify, help us understand, and see what the risk is involved. Therefore, when we bring recommendations to the board, you may or may not know that this has been teed up through risk discussions, but many of the resolutions and things around which you ultimately make decisions have had influence through our overall approach to enterprise risk management, to risk management across the district. And we cite just a few here. So ultimately, again, I think that this policy may be just a little bit more straightforward in demonstrating compliance, and I entertain any questions you might have with regards to this policy or some of the activities of the group.
We had a very robust discussion on the highest level risk already this morning.
Yeah.
For well over an hour, and I think it shows that, to me, the process is working extremely well. And I appreciate it. Yeah.
Thank you, Director McGuire.
We saw red level this morning, and then we had a side bar conversation with some lower ones, then in between. Yeah, your process works great. It's good. I had some follow-on questions, I guess, for afterwards.
Okay, great.
Hey, Scott, I appreciate you bringing up that we look at this all the time, even when obviously, when we're not looking at these higher level stuff. So that's good to know.
It's throughout the entire.
It is not, but it's
Yeah.
good that everyone knows that there's a lot of processes that go through that we never see, and do a good job doing that. I assume everybody else is, but it's nice to get the
The
higher
thing is,
level
is there
stuff.
anything that we would change actually in the wording of the SD-15? Is the question here, is that correct?
From a
First of all, we accept it as it is now,
Yeah.
and then my
Right.
question, is there anything that you would like to change?
I don't have any recommended changes. I think the fact that it's codified, documented in policy has helped us to really do what we want to do, which is ensure that we have a risk-aware culture, that it becomes, that it is and maintains, it probably always was, but it formalizes how it becomes a part of our culture and our decisions. And I would say it has significantly evolved and matured over the past 5 years, and I think especially since 2015,
think it has.
because this policy really does help maintain the strength and the commitment to the alignment of this process. But it's very clear to us, it's very actionable to us,
Right.
and I feel that it's one policy we're able to go through and look at it as stated and say we indeed are compliant and we're doing these things.
Right.
And I hope that through conversations like this morning, there's the feeling through the board that indeed that's the case.
I do have one, I guess, choice of word we might want to look at, revisit. Can you back up a couple of
I go here.
when we mentioned the directors could request management to, I believe, use additional resources. I can't remember which it
Yeah.
was toward the bottom. No, it was the first word of the bullet was actually
Slide 6.
director. Was it slide 6? Okay. When it says directors, and it could actually, the way it's worded, could be taken plural or singular. Should that say the board? Because directors can request. That could imply a director, correct? And really, one director cannot use that authority, correct?
What I would say is that if we have information that's immediately available on a particular risk and it's not tasking the resources of the organization in a significant way, especially if it's something that we may have addressed and it's an individual director, we would share that insight. A good example, honestly, was the conversation that came up with regards to wildfire.
Yeah.
It wasn't the board that had asked for it. It was initially a director, but it felt like it would be for the benefit of the board to have that.
Okay.
So as a risk group, the decision was made really to step back, refine it, and then present it to the board as a whole.
So everyone else, you're all okay with the way it's worded as opposed to saying the board?
Yeah.
Okay.
Thank you for that.
Yeah, I see the difference being very clearly that if the board would talk to one of the senior managers just on any operational issue or activity, they certainly have the leisure to be able to do that. But to say, hey, I want you to craft out a risk analysis around this, I don't think that's their prerogative to do that. I think the board should do that, or certainly that would be my response. But my response would be, let our committee structure go and vet it out and then raise it up as whether or not it's the right risk level, which is how we did the wildfire, which would be a great example.
It's a good example.
And we shared that in that example, that it wasn't a significant risk issue for us based on where we are in the Midwest and where our assets are located. So.
Okay, everyone's okay?
Yeah.
Good.
So regarding how the SDs are formed, this one doesn't have any specific numeric metrics, and it is ongoing rather than time-based. I think that both works. I think both of those features work for this one compared to some of the others that we might need to be
looking at
The
updates.
reporting's got all the metrics.
Yeah, so I think
Just what
this is
you
in
just
pretty good,
said.
I mean, the quarterly reporting seems to be working. I enjoyed the process this morning. I think it covered what we needed to, so I think the
Good.
language here is in good shape.
Thank you.
Okay,
Okay,
thank you.
thanks, Scott.
So we'll be voting on this. This is an action item. I want to thank the entire team, the risk management team that are still here. Appreciate it. They're all here.
Okay, that concludes our report.
That concludes the report. I think we're going to break for a brief lunch. Let's see, how much time do you need? 10, 15 minutes? 15 minutes?
15.
And come back for public information. Thank you. Turn off the.
15 minutes.
ready, huh? Chris, where did Chris go?
Just need a thumb.
Oh, sure.
I just need a thumb.
Oh, yeah, I saw the George H.W.
I think Chris
They're
is.
working.
saw that
They're
sitting
working
outside
on
my
that.
office.
Something's going on in there.
But we saw it there early last week on its way in. It's amazing. The whole train is just beautiful.
Okay, you got the thumb.
We've got the thumb. Okay.
We got the thumb.
Welcome back. The next thing that we're going to be discussing is public information. Mr. Moody.
Anchor relay. Okay. First, I want to talk to a few things that were on our PI pre-committee meeting. So we had a meeting on June 7th, first one that we've had in a while. So a couple things to note, going in reverse order, or actually just bouncing around a little bit. First, the NDEQ public hearing. So to remind, we submitted in late 2018 an application to renew our permit for NC2 ash landfill. It went up to public notice on March 21st, 2019. Soon thereafter, the Sierra Club requested a denial, which kicked into gears at an actual public hearing that was held on June 11th. I don't know that we need to go into this in great detail. The Sierra Club gave us a great opportunity to talk about our state-of-the-art landfill, so thanks to them for doing that. Everybody got update in great detail and diligent on Friday, the 14th. So unless, Lisa, you have anything else to add, I'm just going to mention we talked about it and move on.
We worked really hard on response, and there was a point counterpoint. And there was a support from across the district, and the mayor's group, of course, environmental and so forth. And so Russ did the testimony and did a really nice job. And then John Crabtree stepped through their process. And it was very, everyone was very collegial to each other. So that part was really good.
Okay, so we're going
I do have a
to,
question.
yeah, go ahead.
Is there a follow-up from DEQ on that?
Russ, do you want
Did
to
they make
step
any
up?
statement of determination or?
Not yet.
Not yet.
Well, I mean, is that part of the overall process?
So that's a great question, Director Yoder. During the public hearing, there was no feedback provided by the Nebraska Department of Environmental Quality. They won't do that at a hearing. All they do is collect the comments that are submitted. They take that back to the office, and their leadership team goes through the comments, compares them to the permit renewal, and then they make a judgment on whether or not to approve the permit or not. So right now we're awaiting their determination, but there's been no feedback provided by them on that.
So, okay, good. That was my question. And I'll echo what Director Moody said. I think, state-of-the-art landfills, right? And
That's correct. Built to the same standard as a municipal solid waste landfill, same standards that they have out at, Pheasant Point landfill. Our landfill's built to that. It only takes one product into it, and that's our ash.
Okay, thank you.
Any other questions or comments on NC2 ash landfill? Okay. Next, just briefly, I'll mention we did receive a good update on state and federal legislation. We're going to do that here in a moment, so that's just kind of a teaser for a later discussion, and we'll have a quick presentation on that. And then we wrapped up the meeting in the last 15 minutes or so. So as Javier mentioned earlier, one of the mechanisms by which we as a board are to bring discussions of rates up is through the PI committee based on any customer service complaints that we get. Obviously, whether it's an individual meeting, at a board meeting, via social media, what have you, we're always, maybe not always, but we're on occasion getting questions, comments, concerns from our constituents on rates. And so at our meeting, we essentially threw onto the table, what are the rates of concern? Where are we hearing comments or questions? Where are we hearing complaints from our customer owners? And so the intent was not to dig into them in detail. The intent was to just get them on the table for future discussion and action, if any. So I'm going to walk through. There are three that were really kind of brought to the attention, and thanks to the rest of the board, by the way, for letting the committee know in advance. A few of you did respond, and that was helpful. So I'm going to take these perhaps from simplest to most complicated. The first was rate 464. Is everyone familiar with what rate 464 is?
You should probably tell the public what it is. State it publicly what it is for the
You're going to
public.
require that I have to explain it now, which is a problem.
No, just what the, just a standby. It's, yeah.
Yeah, it's standby service. So if a customer is generating their own electricity, this is the rate that they go on. Over 25 kW, so a generator, a solar array, any of those sorts of things. Primarily commercial.
Primarily commercial.
This is one, quite honestly, that I've been hearing about since I was elected to the board. I know a few of you have expressed this as one where you've heard about it frequently as well. So based on our quick discussion, and again, given that it was sort of a known issue and we've been talking about it over the course of the last several months, if not years, the plan currently, correct me if I'm wrong, Julie, and I'll try and summarize this. There's a team currently developing a proposal to address it. Julie and Javier are going to get it later this month. It'll go to the senior management team soon thereafter, and then the anticipation is that we'll have potential action on that sometime this year. Anything to add there?
No, I would just, I guess, add that our team has worked to understand what the customers' concerns that have raised the concerns with customers, developers, the solar installers, and so I think we have a pretty clear understanding of what the concerns are, and the team is evaluated and is going to be providing us the recommendations, like you said.
Okay.
So we're going to go through the normal, I'll say, rate making process.
And I think this is
Adjustment process.
and I think this is a great example of this rate was originally intended for one reason, and because of changes in technology, changes of use of technology, it may not fit the exact application that it has today. And so it's an opportunity for us to update, think through that, come back to the board with some recommendations of what that may look like. So.
Well, as I understand this rate and the concerns, without knowing the details and the numbers as well as I should, is that it appears to be a barrier for solar install on commercial buildings, and as perceived by one customer, who I have no reason to doubt. When do we have the discussion, board to management, about objectives or about rate setting so as to support the adoption of new technologies like solar? When does that occur?
I think it comes through the PI
committee right now.
I think this is how it happens, is that either we identify a need that we need to go out and get customer engagement on and pursue a potential rate, or like Javier suggested, it's a financial perspective that's arisen of a certain class of customers is creating maybe a higher cost to serve them than others, and we need to carve that out. But the normal process is it would come through one of the subcommittees, either public information or finance, and then go through the reporting process.
So I was unable to attend that PI committee meeting, and I guess I would just say for the record that I'm in favor of rates which support the adoption and diffusion of the innovation of solar power for, well, any customer really, but certainly for commercial customers. I've run into farmers who have that issue as well as kind of larger commercial enterprises. And think I would like to know where the barriers are from, and right now the barrier appears to be a rate, so the other barrier is what is our internal thinking barrier that keeps that rate in place.
And that's what I would say you'll see in the coming months, is what the team has identified from the conversations with the customers and the installers. And then we'll put forth our recommendations based on what we're understanding the barriers are.
Right. So part of that then goes to the role of the utility of the future, right? And our role. And so I hope when you talk about that rate and present it to the board and any changes you may have, talk about barriers and then what our role is relative to the diffusion of new technologies as we're faced with them, whether it be whatever, solar or whatever someone on who is our customer wants to do.
I don't know if I want to, I think barriers is a negative term. I think what we're talking about is initiatives. And, you know, us being able to react to the new environment the way it is right now, as far as rates and everything. So I agree with what you're saying. I just don't like to use barriers. I think, you know, what are changes happening, you know, and then what rates do we have to create to adapt to the changes? Or how do we change the rates to adapt to the changes?
Sure. The quick response is customer identified it as a barrier. I am open to talking about it as opportunities.
But I think there's more than
challenges,
just one customer. I think we're also proactively looking at other things such as EV and everything else, all those rates.
Sure. Well, what I was going to say in response to your comment, Director McGuire, is that I think, to me, the tension has always been about, are we putting in rates in anticipation of when the customers desire to do something and sort of sitting back and waiting for that to happen, or are we creating rate structures that catalyze the adoption of technologies at a different pace?
Good. Yeah, correct.
And I in this case, I agree with Rick. I'm interested in us playing sort of a catalytic role to see how we can help our customers make progress as well.
Well, I agree with the catalytic. I think maybe it's just the terminology.
Sure.
Because I rather like the word, let's have a catalytic role rather than a barrier approach. You know, I guess
well, to
that's
Rick's
what I'm
point, we've had people talk about this as a barrier.
It's
so
semantics.
that's the reason.
Yeah, that's fine.
Yeah. And we've seen other utilities with not just rate structures that support this, but rates that differentiate between locations, right? Because you know, a solar installation can have a locational impact. So, I mean, the one-off with 464, okay, but this is a big discussion. And how do we have it?
So this one in particular, I think, ties back to some of what we had in the legislative update with 509, where I think if we're honest, the attempt to increase net metering, which is kind of the only tool currently supporting distributed generation in Nebraska, was to increase from 25 to 100 kW. And there are no 100 kW residential rooftop solar systems in Nebraska. That doesn't make sense. So the initiative to increase the cap on the net metering isn't really targeted at small distributed rooftop solar in the residential class, which is a non-demand charge account. It seems mostly to be targeted at this kind of gap area now, which is not residential, not community or utility scale solar, but commercial customers who desire to generate some of their own energy and reduce their consumption or reduce their bill or participate in clean generation or whatever their outcome is, but for which there is no tool right now. And echoing that it has been described as this is something we would like to do, but there is a rate which currently was designed for a different purpose that has this kind of side impact of throwing up a significant barrier. And again, this is the word that has been used by a couple people, that it is not kind of having the intended outcome. And so that classification of kind of a general service distributed generation gap between residential and net metering and large utility scale, I think is where we have the issue. And I think that 25 and up kW area is, you know, in an area where I think we can find some success, that 464 is not currently supporting or catalyzing these projects, but instead having kind of an opposite impact. And I think that this will really help because, again, I think that a lot of the discussion around 509 was, quite frankly, not targeted at true net metering in a residential sense. It was attempting to use a tool that was inappropriate to improve rates across Nebraska for kind of this purpose. We can take action internally at OPPD to achieve a lot of the outcomes that were expressed through that process without having to go through another side mechanism, which is having the legislature tell us how to write rates. And I think that would be a big improvement because we know from hearing from our ratepayers what the outcome should be, and I think staff can can come up with some good proposals there, so that we don't end up in a situation where this other mechanism is attempted to be, forced upon us. Quite frankly, I think that'll be a much more direct approach to getting to the outcome that we've heard from our general service and commercial type customers.
And it would be if we have some solutions that can feed that 509-like conversation, and That would be a nice thing to
Maybe,
be able to.
Maybe we could push it back the other direction rather than having it come to us and having to respond. If we take some initiative, we could push it back and say, here's a way that other legislative action could be taken in the future or something. I mean, rather than saying, let that come at us, saying we have proactively recognized the need and we think others could benefit from this type of a process as well.
So I have a question about process. With this rate change, do we have to go through the whole public hearing, public process, since it's a specific rate? I mean, like we did with the wind tariff. Would this be something that we can implement with input from staff and from management and the board, or is this something that has to go through that entire public hearing rate change process?
The public hearing would be the discussion at the board meetings.
Okay.
So, since it is such I'll say right now, it's a small group of folks and stakeholders that are knowledgeable about it and have given us very specific feedback, I think that's what we're relying upon for the customer engagement portion on this rate.
But it has a potential to have an impact on a lot of commercial entities who might want to have solar, rooftop solar or distributed solar. So
Yeah, I think what I wouldn't want to do, I think what we would do is have this conversation with certainly the stakeholders. We would have this conversation with the board. We would say, listen, for the next 30 days, we would take feedback, and at the next board meeting, depending on that feedback, provide input and feedback to the board on what input that we did receive, good, bad, or indifferent. And I wouldn't want to jeopardize that kind of stakeholder input process and expedite it, because I think we begin to miss the piece.
Right.
So I would want to stay somewhat disciplined in that, but certainly not the intent would not be to draw it out, but to make sure that we're consistent in how we look at rate changes or rate modifications or rate updates, whatever that may look like.
Thank you.
Yep.
Any other comments on 464? That was the easy one, as a matter of fact.
It's a good thing we did eat lunch before this.
That's right. All right. Anything else on that one? Okay, so the next one we discussed was the infamous Green Power Program. I think everybody is familiar with and knows what kind of the general issues are with respect to this current program. So quick update on what our understanding is based on the conversation on June 7th. The product development and marketing team is working on our product and service evaluation framework. That's under Julie's guidance. And they'll be evaluating and recommending recommendations with the anticipated changes to be executed in 2020. So Julie, do you want to talk a little bit about that team's process and what they're going through?
Sure. So they're going through a process, again, getting feedback from the public. We've certainly heard some of it, but we're evaluating all of our programs and products and services against an evaluation framework that's going to be looking at customer satisfaction, the financial aspect, risk, all those different types of things that you would evaluate from a product and service. This one in particular, we've heard the comments in the past, and so the team is looking at how can we address some of the concerns. We believe part of it is about education, about how that program was set up initially, and the things that those revenues that we've received from customers, how they've been applied to support OPPD's investment in wind many, many years ago. And so, but we also believe there's, what do we need to do moving forward with that program? And are there additional opportunities for people to participate, customers to participate in that program and do some different things with it going forward? So again, the plan would be my team will come up with the recommendations. We'll review that with senior management. In this case, it's a customer program, and so depending on the types of changes that are recommended, it could just be a reporting item to the board. It would not require action item unless we go and have language changes or specific changes within that rate 463.
Right.
Can you explain, just for the public, people used to think that was just like a rate or whatever, but can you explain 463 with the green rate and how that might change what you just said?
So the 463 is a voluntary rider that either residential or commercial customers can participate in, and they are able to pick their participation level and that they want to contribute towards green energy or renewable energy. And it defines it as wind, hydro, solar type generation.
And is that the green program?
That's the green
That is
power
So the green
program.
power program, it's a rider, not a rate.
It is a
what you're
rate
saying.
rider.
It's a rate rider, okay.
So you're on your residential rate and you opt to be part of the green power. The amount that you're paying for green power is determined based on how many shares you say you want to do,
Right.
and the rate associated with that.
And we don't vote on that? Because I thought we did vote on the green. Because
You did
certainly we
vote to
did vote on
establish it, so I guess what I'm saying is if we change the definition of green power, or if we change the values of the contribution or the pricing structure of it, that would be an action item, because that's specifically defined in that rate rider. But if we're just changing, our marketing approach to the program, or something else within the program that's not specifically defined in that rate rider, then we would just report to you that this is how we're using these funds moving forward.
So how the funds get set aside, how
Right.
they get used, all of those kinds of things are on kind of the backside of that rate.
And the funds don't get set aside.
Yeah,
They
right.
get, yeah.
Yep.
But you do have the opportunity to do that, and if you were to make, I'm not saying you should, but if you were to do that, is that something that would be reported back to the board or required board approval?
I would say it depends on what avenue we take, whether it becomes an action item for the board, or whether it's just within the construct of the program as it exists today.
Julie, do we have an idea on the level of our participation? How many customers are?
We have, today, I think we have about 6,500 customers that are participating in Green Power Program. And that's been fairly steady.
And will we see an updated list there? Because I know some have shifted from Green Power Program to Community Solar. So there's probably some transition there, but I'm curious what that impact has been. And it's been mentioned that we should evaluate the Green Power Program because of this new program opportunity.
Yeah, at this point, I don't know that I've seen any, but I certainly can get you stats on that.
Yeah, we also asked, I asked that question to Julie,
Yeah.
is to say, what kind of transition have we seen from people from the Green Power Program over to the Community Solar initiative? And so what does that look like? And so whether or not it's easy to get that information or not, I don't know. So we'll see what kind of...
We had almost 900 customers that signed up for Community Solar, so at this point, it's somewhere less than 900. And I don't know that all those 900 participated in Green Power.
Yeah. So I think that two of the comments that I've at least heard on this one in particular is transparency about where the funding is being used, and then input as to how the funding, transparency about the funds, and then input as to where the funding gets used. And so those are the two kind of specific guiding questions or comments that I think we've heard a number of times. I'd be surprised if we don't hear them on Thursday. But I think those are kind of some of the things that I would hope to hear back from some of the evaluation that we're doing.
Yeah, so we believe there's education that needs to be done, and maybe some formal comments out on our website that better explain the Green Power Program.
Yeah.
So I agree, there's some education opportunities there so that everyone has a common understanding of intent and what's happening, but I don't know that it deserves as much energy as the opportunity that you have with this fund and how to craft it to create some new wonderful product. Right?
Well, and I think the important piece is it's not our fund. It's very specific customers giving very specific dollars for these reasons that they decided to make that. And so I think my concern would be we make an arbitrary decision on where those funds go without engaging those Green Power Program customers in what their perception is if we decide to make changes, right? So that's the stakeholder piece that we would certainly want to align, and I'm not sure you're saying anything different than that, but we just want to make sure that we balance that, because I think we have to be mindful that it's our customer owner's money and what's the best way to use that. And whether the recommendation is to modify it, is to think about it differently, or to say, listen, we're just going to get rid of it and we're going to let customers know we're not going to do that program any longer. and allow them an opportunity to do something else with those dollars of revenues. Don't know where that's going to come from, but that could be one of the recommendations. And so just, I think we just have to be sensitive of that.
So part of this, when you have your product people, you're going to be reaching out to those green power people.
Yes, we
such
will
as
do some
myself.
stakeholder input.
Yeah, you get the stakeholder input as far as a survey or something like that, as far as what other things would you like?
Okay. Good conversation. Any last thoughts or comments before we move on? Hearing none, here we go. Last one. So rate 110, so there are a couple things wrapped into rate 110. That's the residential rate. The first is obviously the fixed fee that we've talked about many times over. And then the declining block rate also rolls into that. Both of those things were brought up as rates that where we've heard from our customers concerns. Again, we've talked about these 10 ways to Sunday, so we don't need to get into the detail today. I want to echo a couple things that were said earlier today as we were talking about SD2. One is a comment that Director Williams made, which is the need for the public to understand everything that goes into how these rates are made and why they are the way that they are. And I'll echo something that President Burke said, which is we want it to be planned and approached methodically. So we're not going to be super quick to move on any of these things. You know, I think this idea, it was interesting for me today to think about no general rate increase really is about the net revenue requirement and how those things kind of balance themselves out and the terminology there. I think one of the things that I think we know, you know, even if we make a revenue neutral change, the public is still going to look at that with at least maybe potentially a raised eyebrow about what are we really trying to do there. So I think those things are important for us to take into consideration. We know that management is also seeking opportunities to extend the low usage, low income program until December 2021. That's something that you can do without our approval, as I understand it. So that's on the table. So again, my understanding of next steps, and I'm going to look to you, Julie, to kind of reinforce and elaborate a little bit. But management is looking to see the development and execution of a customer engagement initiative, as I understand it, kind of for two purposes. One is to educate people on what this is and why it is the way that it is, and two, to obtain input so that we can get a really good, true sense for what our customer owners writ large, what their perspectives are on this particular rate. And then those two things will, in addition to obviously incorporating the feedback of the board, help us make some decisions way down the road. I'm going to turn it over to you now to let you elaborate.
Yeah, so thank you. So our thought is that we were very methodical and we went out and we did customer research and got customer feedback before we went into the rate restructuring. And now to shift it, we're kind of in the same position. And so you'll learn more about the customer engagement strategic initiative next month, but we feel that we can weave this effort into seeking more input from our customers and really diving into the concerns about the residential rate. We know we've heard primarily about the low usage. Are there other customers that have concern? Are there others that are completely satisfied with where the rate is? Mm-hmm. And so we want to go through a similar process to do the surveying, get the engagement, and make the appropriate recommendations based on the the cost of service is the bottom line of how we set our rates. Can we differentiate our customers in different ways based on how they're using our system? Yes, but as you heard Javier say, there's technologies that are needed to do that. And so what does that look like? What's the time horizon on that? And what's the time horizon of that relative to the no general rate increase that we've established? And so we feel like if we could take the time to get the customer engagement done, the research, and come back and have a very thoughtful proposal on what we do with residential rates as we move forward, that would be the more appropriate thing to do than to rush into some changes on the residential.
So timeline then on that?
So our strategic initiative is going to be kicking off like August, and so they're working. My team is working on the plan right now of what that would look like, and so it would be over the course of 2020 is when I would think we would be getting feedback from our customers, and then if you timed it with the general no general rate increase window, it would. You would be voting in December of 2021 on if you were going to make any changes for 2022. So January 1st, 2022 is when that window is over.
And this is why I asked so specifically about what the definition of a no general rate increase is earlier, because at APPA, can't tell you how many consultants highlighted that a declining block structure is kind of an outdated and inarticulate method that has been used in the past with low fixed fee bills, but as the fixed fee portion comes up, the declining block is less necessary. And so we made one change in the rate structure, and the other side was not adjusted, but has some negative consequences to discouraging conservation and to low users. And so I would guess that Janice heard this as well when she went to her rate classes. I think that's the definition of the no general rate increase is really important, because the structure between the fixed portion, we don't yet have a demand portion on a residential bill, but the energy consumption portion, I think, is worth investigation on a timeline as soon as we can reasonably come up with how does this match the revenue requirement that we have.
And my comment would be is that if we're looking at extending Lully, and what is the cost to the organization for that extension? And can we achieve the same results by flattening the block rate? Maybe doing that would be a good alternative. Because if you think about it, with the Lully program, all the other customers who aren't getting that subsidy are paying for low-income, low-use customers to get that subsidy. If we can achieve the same result through doing away with that block rate that we currently have and making that flat across the board, maybe that's an alternative. And to wait, 2 more years or 3 more years to address that issue, I'm not sure that's.
So I think when it comes to the revenue neutral, and Javier spoke to it, Craig spoke to it, if we alter the block rates, then you're going to have, much like we had with our rate restructuring, you're going to have people that are going to see increases on their bill. You're going to have people that see decreases on their bill. So ultimately, that can impact customer satisfaction. It could be a yo-yoing of people that are satisfied now will become more dissatisfied, perhaps, with that change. I think management supports the adjustment of those blocks. Our concern is about the perception of we made a commitment on no general rate increase, and from a customer's perspective, based on the calls we get, revenue neutral, and that means nothing to them. They're concerned because what they see is the bottom line on their bill, that it either went up or it went down, and we hear from the people that it went up.
I guess I would point out that Mark Beauchamp, Utility Financial Solutions, he was in the book that we all got from the APPA magazine, specifically highlighted that declining block rates are cross-subsidization. And since we talk routinely about how we try and avoid that, that is a known version of cross-subsidization from one group to another that was not addressed last time rates were restructured. And I think that should be something that we prioritize as an area where improvement can be made.
I don't think we disagree with that.
Yeah.
Now, we may disagree with whether it's cross-subsidization. I think that may be Mark's perception on that. But I think as we kind of move forward, I think we agree we need to do that. But we want to do it as you address that whole rate, and to do it in that manner, that you would lay out that stakeholder process to begin to do that. Because I think, the concern, and you all saw it in the Rate 201 conversation, it's just not the low income that's the low users, it's the low income that are the high users. And so you're going to have that same impact. And I understand the concern about, you may be incenting more use in that low block. I would contend most customers in my work and my conversation over the last 45 days on this topic with customers, they don't know that there's another block rate below the current rate. They see their bill. I think our thought process is let's get through the 5-year no general revenue increase process, and then let's have a thoughtful process about what all those rates should look like. And are there ways for us over the next period of time in 2020 as we begin to research this, get customer input, begin to think about generation pathways, to begin to think about other kinds of technological things that we want to do on distribution automation, how will that impact customers' rates going forward, and what does that look like? I think that's the implications that we want to share in those strategic initiatives and come back with that kind of thoughtful piece on what that may look like. I don't think we've done the assessment and saying, if we just got rid of it today, what would be the economic impact? I don't think we've done any of that. But I think the thought process that we have had, based on some of the concerns, is let's make the extension of the LULI through the end of 2020. Just extend it through the end of that year, just to make it part of the calendar year and the kind of the rate process year.
When is it set to expire?
20.
It was originally set to expire in June of 2020.
Yeah.
The LULI was.
Yeah.
But rate restructuring was done prior to the rate freeze, if you will.
Freeze. We had rate freeze. One other thing that when I went to the rate meeting is they also said when you do rate restructuring, you cannot go too quickly. It takes a lot of stakeholder process. It takes a lot of communication. When I see here, I see a 1.5-year time frame is what you just gave us. To me, that's a reasonable time frame to make this major change and to research everything, to have the stakeholder process. Going through a previous stakeholder process, it takes at least a year to get through this process. And after that, then you've got to go into, okay, well, how are we going to do this? So I actually think that the time frame is good on this.
So it's 2.5 years.
It's 2.5 years? No, I'm always
After we took board action, how long was it before
But still, it's wild.
a change went into effect? We took action, it was several months, close to a year, wasn't it?
Yeah, but when we started having the conversation, yeah.
I mean, if that time went.
So we started the conversation in June of 2015, I believe. We made the rate adjustment in December of 15, effective June of 16, if I'm not mistaken.
That's right.
I'm sorry, I was not here at the time. So the conversation meeting on the board started in June of 2015?
Yeah.
Or the stakeholder engagement process?
We had several conversations with the board around the conversation around fixed versus variable, and we began to have the conversation over a period of months with the board.
And when did the stakeholder engagement process start leading up to 2015?
I don't know the specific dates, Director Williams. My guess is it was after the early education with the board, probably in the September, August timeframe.
And that's when we already started testing in terms of what would resonate with customers and so forth.
Yeah, and well, the other thing we're talking about this date, then I'll go back, maybe I was wrong on the 1.5 to 2.5, but the date is that we said for 5 years, no rate increase. If we change and we're going to do it 4 years, there's going to be people who are going to have rate increases.
Right. Good luck selling that.
Good luck on that one. I mean, we promised them the no rate increase, and that's where you have to, if the board wants to take that risk,
And
they
the focus
can,
would be
but
on
I'll tell you, if you
kilowatt
ask the stakeholders, they're not going to like that.
I mean, but the rates have been changing since January 2017. The fixed fee has been going up, and that has had
That's
impact.
not a rate.
That was the rate restructure.
So then a change between a fixed fee or the
That was
declining
a
block
rate
structure is
restructure.
not a rate restructure, or it is a rate restructure? And this is what I was asking earlier.
It was a rate the fixed fee changes were a rate restructuring, and that was approved. And when we said that we were going to freeze our rates or have no general rate increases, it was also stated that we were going to continue with the rate restructuring, but we were not going to change the general rates.
The revenue.
Other than outside of the rate restructuring, which increased the service charge and lowered the kilowatt hour charge.
It does seem a little confusing, doesn't it?
It is confusing.
It is.
And I guess I asked about the stakeholder process because we just outlined 2.5 years, and then I thought I just heard a stakeholder process described that was less than 6 months in 2015.
Yeah, I think what we're saying is we wanted to get through the no general revenue increase of that 5-year period. That was the conversation that we have had and said, we'd love to be able to get through that and then begin to make those changes. One, just to live with our commitment of what we said we were going to do, right?
Right, I think that's the perception aspect. Are we living up to our commitment of a no general rate increase? And it all comes down to perception.
You know, it comes to perception, and also if we wait that additional year, well, we also have a better idea of the new type of metering systems that we may have that we can also implement
If this
go with that.
If this is the perception problem, 8 of us have public perception issues that we answer for directly. And I am prepared to stand in front of people in my district and say, yes, we move forward to understand this and make changes to better reflect the cost recovery and correct a known inaccuracy in the rate structure that was implemented recently faster than 2.5 years from now.
I'm not sure that it's an inaccuracy because when the service charge went up, all of the block rates were adjusted accordingly. And if this would be Javier's area, and we don't have our subject matter expert in here, but that the declining rates are about how much fixed charge is getting recovered in that kilowatt hour charge. And that's why it declines, because the more you use, after the 1,000 kilowatt hours, you've contributed historically to the fixed portion of your bill. So if you don't adjust it downward beyond the 1,000, the high users are contributing more towards the fixed.
So here's what maybe we could do. I think there's, let us put together kind of a deck to the Public Information Committee about the facts around it. What was done, what we did, what were the impact over each of the changes in the customer charge increase and the kilowatt hour reduction. And let's just put the facts together. We'll put the facts together when we had a conversation with the board on the front end, what we did, how we did that. And let's put that together in detail for the Public Information Committee to see and to hear. And and see where the next steps are from there.
And that's one approach. I'm sorry, go ahead.
I just want to say that when we were going through that rate restructure, we were told at those public meetings that shortly following the rate restructure, that this organization would be looking at the block structure, and that would be something that you would be looking at to flatten out the impact on low-use customers. And so there was already some discussion at that time that once the new structure was put in place, that OPPD would be looking at the block structure and make sure that wasn't having as much of an impact on low-use customers as you knew it was going to have. So flattening out the block structure doesn't have to increase our revenue. It wouldn't be a rate increase because it would be revenue neutral. So waiting another 2.5 years to do something that was talked about during the public information part of the original rate restructure, to me, is not reneging on our promise for no rate. So get us the information.
No, that's what I'm suggesting. Let's get the facts.
I
Let's put
appreciate
it
that.
together.
I just think that another 2.5 years on this is a long time for something that was actually on the table back in 2015.
There was some initial work done on it, not the full-on typical rate thing, but there was some initial work that was done to look at the declining block effort. But then I think, the decision was made about Fort Calhoun and freezing rates, and so that's what kind of tabled it at the time.
Kind of a new issue based on something you said, Julie, I'm sorry, is I'm concerned that the same person who oversees the demand side management program and the usefulness of rates in reducing high energy consumption has such a solid defense of declining volumetric rates for higher use. Didn't I just hear that?
We don't have a defense for it at all.
I think I said that
I think we agree.
are in agreement that at this point you could eliminate the block rates.
Yeah, there is
My
no
def- my
agreement
def-
on this issue.
My defense
From a
is-
management perspective, it's
perception.
a timing.
Right.
That's our,
Timing and
I would just
perception.
raise our issue is
Right.
that fundamentally, we don't disagree with you on that at all. We get it, we understand that, and we did earlier, right? And hindsight, several years ago, should have taken that into consideration when we did that. Didn't do it. We are where we are today. And so I think our perspective is we don't disagree with the fundamental principle of we shouldn't have declining block rates. We understand that. The issue for us is what's the timing and are we living up with our original commitment to be able to do that? And that was not pre-described 3 years ago. So this would be something in between that we didn't pre-describe 3 years ago when we started the increasing of the customer charge and the reduction of the energy charge. And so we felt that was different enough that we did not want to move forward with it in this time. I'll go back to what I said. Let us get the factual data to the Public Information Committee and have that opportunity to have that conversation.
Can I clarify
Of
what
course you can.
may have been perceived as being defensive is I think we need to be very clear with the public. We don't design our rates to incentivize usage one way or the other. Our rates are designed based on the cost to serve the customers. That's where I get defensive.
Well, I took a note specifically when Mark was speaking. I think I said cross-subsidization. What he actually said was, quote, declining block is not based on cost recovery.
Well,
And that is from a rate consultant who presented at APPA about the way rates are structured.
But
So-
Director Williams, I understand what he said in a broad concept, but for him to not to know how we are recovering cost within our rates, I think is a difference between a broad concept and what specifically is occurring in our rate structures and how we're recovering rates through revenue generation.
I would say in an ideal world, if you have a three-part rate and you're fully recovering your demand cost and your customer cost, that statement is correct.
And
In a world where we are not recovering our demand cost and we are basically recovering some of that through the volumetric charge of a kilowatt hour energy cost, that is when the logic that Julie presented earlier on the declining block rate applies. And it has been in the past a solution to a problem that has been caused by not having adequate rate alignment between cost causation and rate recovery.
And so if we're talking about the next 2.5 years, are we looking at moving to a three-part residential bill in that same timeline?
I think I would ask you the question then. You are the rate maker. I would say yes, I would like to, but it's up to you.
That's technology based.
Are we looking at an interim technological answer that could provide something like a grid access charge? I mean, if that's a 2.5-year time discussion, I am much more open to saying that we are moving to a restructuring to get to better cost recovery
That was
with
my
technological
whole idea.
improvements.
Yep.
But
It's going to take 2.5 years to do that as
Just
far as
taking
tech.
2.5 years just because it's an arbitrary timeline doesn't make sense.
No,
But-
it
mean,
has
but
to
with
be-
the
If it's
expectation
tied
that-
to technology, yes.
That's
but-
what I
but
had
not just
mentioned
because
earlier.
we're waiting for that 5 years to.
And if that's the
build up.
case, I think that is an extremely important piece of public education that we need to be prepared to get to everybody, starting immediately and saying, we are looking at, there are much more accurate ways to allocate costs to those who cause them, and we are looking at making that improvement once we get outside of this 5-year timeline that we previously agreed to. And that is the kind of the broad spectrum of rate restructuring that we might consider after the 5-year timeline.
I'll double down on the doing it right away, and I think it links back to that conversation or the comment I made earlier. If we're waiting on technology or we see some technology making it happen, it's also part of that framing of our utility of the future and how we get there. And right away is not out of the question in having this discussion.
All right, so I'm going to sew this up. Told you, we started with the easy one. Sounds like we've got some next steps through the PI committee. Obviously, we'll be discussing this further, and we'll think about ways to make sure that this conversation is well-informed, and we're all thinking about how we can get on the same page and go in the same direction. Good discussion. I'm going to turn it back over to Ms. Olson to talk and wrap up our meeting today with state and federal legislation.
You know, I was so worried because we sent Tim O'Brien down at a press conference at 10 o'clock this morning to receive an award for economic development again, and I was worried he wasn't going to get back. Sorry, Tim.
Nope, we're
I
good.
told you to drive safe.
Thanks.
So kudos on that. Once again, OPPD helped lead the way there, that the governor was able to receive an award for economic development. And with that being said, last Thursday, we were at Facebook, Julie and Tim and the rest of the team, and the kudos was all over about OPPD and the rate 261M, and how really the governor said we were the linchpin, basically, that brought Facebook here. So, congratulations. With that being said, we closed up the legislative session May 31st. It started January 9th. It was a long session, a really long session. So we're going to do just a really high level on that, and then the interim studies is the important part because that's really where we're at right now. Per Director Moody, we're going to forego the federal for right now, but that is in the bill tracker on Diligent. So take a look at it, and then we'll address that as well, if that's okay. Okay. Mr. O'Brien.
Thanks, Lisa. Good afternoon. As Lisa said, I've got 4 things on the agenda for you. A very quick summary on the legislative session that recently ended. We will talk about very briefly the activity that took place from our last update that I provided in May. We'll spend the bulk of our time on interim studies, and then we'll just give you a quick next steps of what goes on through the interim after the legislature convenes. Here's the calendar that I've shown through all the updates. As Lisa said, the state legislature concluded on day 84, which was the 31st of May, a few days earlier than they had originally anticipated. There were 739 bills introduced. About 250 were approved and will move into law. Some are immediately moved into law, and others are about 90 days after the session ends, if you're wondering about when some of the bills become into law. We tracked well over 75 bills, probably quite a few more than that, with a lot of activity around 15 of those particular bills from those items. So now we move into the interim study process, which I'll speak about in 2 slides. I'll be very quick on this particular slide. We've discussed all of these bills in great detail, and really they moved after the last update in May to a final reading status, and so there was really not much activity. But one thing I want to point out, if you look at the dates of when we show when they're passed, all the bills on this particular area have really no opponents. Some folks have chose not to vote, but it was kind of unique to see that the bills of interest to us have pretty significant momentum, I guess, from the body of the legislature. So several of the bills there, I want to highlight 218. That was a bill that took great work across the district. Seth's worked on that for a couple years, and I want to thank Seth for all of his work through the session, and Tom Richards as well. They were extremely busy and continue to be as we move to the interim. Probably the last bill, LB 720. This came towards the end of the session, and it did not move forward due to filibuster. So there'll be some version of this back next year. We were a little disappointed that it didn't move forward, but there was a lot of discussion and debate on that particular topic. So I don't know if anybody has questions, but I wanted to make sure that the board and then the public had an update on this particular slide of where we moved to.
Amendment passed and what it was exactly?
Yep. So there was quite a few movements on 155. The specific amendment that you described was related to net metering and a topic that the senator wanted to bring about to the legislature. So he added that amendment. They had a discussion. He withdrew the amendment, and then the bill moved forward intact.
So that amendment was not passed?
It was not passed, no.
Okay.
Nope. Any other questions on any of the final bill movements? Seeing none, I will move to interim studies. And in the interest of time, I'm going to speak on 9 of them. There's 20 that we're tracking today, and there's 9 that really relate very closely to our business. The rest do, but we wanted you to have the full list and the public to be aware of that. So a little bit of background on interim studies. Senators introduce a resolution to have an interim study about a particular topic of interest, maybe of their interest, maybe of constituents, or something that comes up in the legislative process. Study might not be the best term. I often look at it as a hearing perspective. So if a senator has a particular interest, they may hold a hearing to talk about issues or perspectives on a certain topic. Some actually do move into studies, and so it kind of depends on how those things work. The studies get assigned to a committee. The committees then prioritize how many studies they will focus on. That's happening right now. And then the activity happens with the particular legislative resolutions or interim studies. A lot of the hearings or discussions happen after Labor Day. Typically, some are getting scheduled now, and they must be completed by December 1st. So that's sort of the process. I looked this morning to make sure there's 143 interim studies that were introduced. Again, we're tracking 20. We may add more to our list as we start to learn more. One thing you may find if you pull a legislative study on the legislative website, they're very simple. And so basically the notes that we have, that may be all that's the scope of the study. So I'll give you an example. I just grabbed one here. This is LR 96. It is the exact same note, and then it tells which committee it's assigned to, and that's really all that's in the document. So it's important that our team works very closely with the senators interested in this, their staffs, to understand the scope of the studies, and we're very rigorous in doing that right now. So that's the scope and kind of how the interim study process works. So I want to walk through 9 of these very, very quickly to give you the high-level points. The first one is LR 65, so I'm going to jump around. There's 3 slides on these particular legislative resolutions. The first here is about underfunded defined benefits or pensions. This came into law a few years ago. Javier's came to the hearing that's required by this particular legislation a few years ago, and so this is to provide a hearing for entities with underfunded pensions. I believe it's 80%, I think, is the level that come and talk about the status of their pensions. So that one is more, I would say, procedural in nature. The next one of interest to direct interest to our business is LR 96, and this was introduced by Senator Slama. Just for background, her district is much of our Southeast territory, matches very closely with most of Director Yoder's territory, and so our Nebraska City station is there, Cooper station is there, and the study that she proposes is to study the long-term impacts and decisions of transmission and energy generation, and so that study will be conducted or of interest by that senator through the Natural Resources Committee. The next one, LR 131, jumping down to the middle of the list. This interim study has a few components to it, but it's really taking a look at regulations through municipalities, homeowners associations, or sanitary improvement districts around how they view distributed energy resources, most specifically solar, and how there's covenances or other things that may inhibit those types of growth of those particular energy opportunities. So that's what this study is undertaking or attempts to undertake coming up. I'll jump to the next slide. There are a couple on this one I wanted to bring to your attention. LR 145. This study is what I would say, of reading the study characteristics, it's about benchmarking the PACE, the Property Assessed Clean Energy Act that Nebraska made some regulations kind of around a couple of years ago, and they're benchmarking. So the study talks about looking at other states on how they implement this particular program, and if there's any opportunities to enhance the structure around that in the state of Nebraska. The next one is 169, and this relates to the one-call notification system. We've spent quite a bit of time, if you might remember, on LB 462 around the one-call notification system. The senator that introduced this has continued interest to look at refining and enhancing the one-call process. The study that's introduced here is very much focused on the dispute resolution and the process in doing that. And so they've set some parameters on how they're going to look further at that particular component of the one-call system. Looking at the last page, there's a few on the last page. LR 207. This one is a all-encompassing, what I would say, look at the taxation of goods and services, so really sales tax. That was a very highly debated topic in the legislature this year, and so this is carrying that into the interim to look at that. Certainly the size and scope of our organization, we relate to a lot of those business inputs or sales tax related items, and so we'll keep a keen eye on what might be discussed in this particular study. I'm going to jump down to 227, and this one is to study examine the future of nuclear electricity generation in the state. So as we've looked at the legislative resolution, it walks through several segments of what's the history, the current status, current comparison of cost of nuclear energy, and then what opportunities might be available in the future for nuclear energy in the state of Nebraska. Two more that I want to speak of, the last two, 231 and then 241. 231 is kind of interesting. The kind of introduction into the study talks about some of the great things that are happening about many economic development opportunities across the state, and then on the unfortunate side, flooding and other things have kept all electricians very, very busy. And so this particular bill is looking at how a pipeline can be developed to further electricians, and then a little bit further it talks about encouraging folks to move into the trades segment. So really, I think kind of a neat workforce development bill. It has some specific things about licensing of electricians, and so it's something we'll keep a keen eye on as well. The last legislative study is 241. There's several senators that are associated with this particular study. As you might read the highlights, it's really focusing on how we prepare and respond and have the best resolution for dealing with, unfortunately, some of the natural disasters that we've had. And so the resolution talks about how we will do that. You can see they're looking at assessment, risks, and opportunities to build a plan to, what I would say, be more resilient in the response and preparedness to natural disasters. That concludes my interim study update. Yes.
So how does, who determines if the interim study is going to be held? Is it actually the committee who would have authority over it?
The chair of the natural resource, or not resource, the committee guides and sets them out, and usually the person associated with them helps coordinate, or their staffs coordinate, if that answers your question.
Tim, was this just a list of all interim studies, or those that we're watching?
Impact us.
This is the
impact us,
Yep.
okay.
Or could impact us.
Yeah.
And to the could impact us, is that why the broadband is on this?
Yeah.
And this list has the longest that I've ever seen in the time that we've been doing this.
These studies take longer than the session does.
Pardon me?
These studies probably take longer than the session does.
It just depends on.
Some of them
Depends if
take
they're
20
further.
minutes.
You might not be
Right?
further.
They may take a 20-minute hearing. I think we saw one last year that we ended up hosting at the Omaha Center. That was a relatively short hearing, and a couple comments, and that was it.
And some don't even have hearings. What I've seen in the past is the committee may have their legislative counsel, their legal
aides.
counsel do present a white paper.
Yeah, the white
They
paper.
may not even have a hearing. So
And then a lot of it's not, most of it's not funded, is that correct? Or any of it?
Right, it's just done with,
No.
it's
Sometimes
rarely,
it's
yeah,
funded.
it's rarely funded separately. It's,
So
None of
as-
these are funded, no.
As discussed in the PI committee, notably absent was anything related to net metering. A, any background on why that did or didn't happen, and then B, I'm curious as to what and how we will engage with others to have that discussion so that inevitably when it comes up next session,
Yep.
the conversations of.
Thanks, Director Moody. I appreciate that question. Certainly, that remains a topic. Some of that may slide into one of the resolutions that I mentioned. I think it's 131. There was, I think, some interest from several senators on net metering, and ultimately one didn't get introduced for a variety of reasons. I'm not sure to speculate on really what that caused, but certainly an interesting topic that folks have, so we'll be continue to engage in. Certainly from the discussions the board had earlier, it sounds like we'll be working on our solutions and opportunities in that space as well.
I heard an interesting description of net metering the other day, that it's a rather blunt tool for actually getting what we want done. So maybe by the time it gets done, we'll have already leapfrogged.
Yeah.
I just hope it doesn't prevent us from doing what we want to do. So
Just
we should go ahead.
to wrap up our next steps from kind of closing out at least part of the state session, and we really do get busy with the interim studies, and so we'll be working through that. We continue to work really closely with the Nebraska Power Association and the coordination there, which is really great. They kind of do a deep dive of the session, and that'll come up, and then there's a lot of education that happens now through coming back to the next session. And then from our specific work, we do a lot of outreach and discussions with folks interested in these topics, as Director Moody
We will
mentioned.
be enhancing our coffees, community coffees and so forth during the next several months. So we'll be hitting the road.
Nice. We'll be happy to have you down there.
And up north.
Just one process question. So the committee members are all locked in through the next session too, is that right? They don't change?
No change.
Yeah, all right.
It's too bad.
May I just close with Seth, thank you. Joe Lang, subject matter expert. Tim O'Brien. I mean, we had people all across the district that were at hearings and were on the other side of the glass lobbying as well. So
Good work
a
to all.
team effort.
Indeed.
Yes, that was, we realized how much time that took. Tremendous amount of time.
And thank you for
effort.
giving us the flexibility, because like we said, it moves
It's crazy.
fast.
This is the craziest I think it's ever been. And I've heard some other lobbyists who've actually talked about that. It's the craziest they've ever seen in the legislature.
So thank you for your support.
Yeah, of course.
Thank you.
And that concludes the PI committee's report.
Thank you. Okay, if there's no other comments or, we are adjourned. Thank you very much for the long session.